It's 12 o'clock. We've got 16 people on, recorders on. I think it's ready to get started. So welcome everyone to E5000. This is our first financial ratio web conference. The reason I started this web conference was the most challenging part of our class is the financial ratio side. And I've also found that for a lot of people, this is the last class before they graduate. And some of them feel like they should know all this stuff and they're afraid to ask all the questions that they feel they should have known from years before. So this is basically me, Michael McCarthy, your TA, and the professor's not here. So you're really encouraged to ask super basic questions, things that you think you should have known, but you don't. That's okay. That's why it's also peer taught. So everyone's going to be giving a case study. If you have questions, please raise your hand, and the presenters, you're going to be calling on people, and then I will manage the chat room. For the most part, I'm going to be focused on the slides and making sure that people's mute buttons are working. So if you don't get a quick response from me in the chat room, please raise your hand. That's easier for me to see. So if we're ready to begin, Tom, you're ready to go?
Yes.
Okay. Just tell me when to advance your slides. Go ahead.
Okay, you can go ahead and advance it. So everyone here, I did the balance sheet, and I'll go through a couple high-level overviews on the balance sheet and then use a fictitious, but yet somewhat realistic example with my son. What I've found is when I was trying to learn this, actually how I learn anything is I really need to bring it back to home and come up with an example. Things don't come innately to me. So I almost have to teach myself, and you'll see in the example. But one of the first really important things as I see it in a balance sheet is to, again, look at it. It represents a point in time. So for companies, it's usually the end of a quarter or the end of a fiscal year. The big key there is a fiscal year. So Hitachi may run from March 2015 to March 2016, or February to February. So again, it's a fiscal year, not a year-to-year point like we typically think of. So it's always something to be cautious about, to make sure as you're looking through a balance sheet, what is the time frame, what is their fiscal year? So again, it represents a point in time and this is because things change. So even if we think about it personally, my personal balance sheet today will change when I go to Chase, or if I go to Walgreens and spend money. That now has affected it. So this is, again, everything in a business or even on a personal level changes every single day. So this, again, is just a snapshot in time. And again, keep in mind fiscal years. So for large companies, when you're looking through, and these are some of the terms you'll see, a 10K, which is or known as an annual report, or a 10Q, which is a quarterly report, they'll typically list in millions. So if I saw 145, and it will say up on the top left-hand side, when you're looking at a report, it'll say in millions, I know it's 145 million. Or if I see 4,100, that'd be $4.1 billion. So again, that'll be noted on the top of any balance sheet you take a look at. Again, this is probably the critical one that I learned early on, and it simplifies it in my side, or my mind, that the left always has to equal the right. Meaning, again, it has to balance. So if you look at the equation, it's assets equal liabilities plus shareholder equity. You could use different terms, such as my net worth equals what I owe plus what I have. Think about it that way. So again, these always have to balance. So if I ever become confused on a problem, and I'll show at the end, if I don't understand what liabilities are, assets and shareholder equity, I can just plug and figure out what liabilities are. So again, I think that's critical. Remember, just think of the name, it has to balance. And I apologize again if this is redundant for some people that know some of this, but I think it's important. And then finally, a lot of the ratios we're going to go through today come from this balance sheet, income statement, or statement of cash flows, and we'll probably learn how they all tie together. But again, so this is a critical one to understand. So I'll start with an example. If we go to the next slide, Michael. And this is very simple, but so what I did was, you have the executive team up there, my wife, my son, and some random Lego guy from Legoland. And so what I'm trying to do here is pretend like my son starts a business. Okay, he's going to sell Legos. And I put in there it's a low number for Legos because we've spent, I don't want to pretend to imagine what we spent on Legos. So on the top left-hand side, my son has $1,000. And the way we want to think of this as a business is he's now investing it in his business. So we won't have to divorce the fact that he just has this cash laying around. Let's say he starts, let's say it's called Colin Legos LLC. So he has $1,000 cash, and his initial investment is $1,000. Okay, so these, again, they have to balance. So we can't just say $1,000 cash and nothing else on the right-hand side. I put up there assets, so he has, and I put what he owes. It's not really what he owes, it's more his equity, but we'll get into that deeper. So again, the left, I start my business, $1,000. Colin's investment is $1,000. So what happens is he comes to me and he says, you know what, Dad, I don't have enough money. I need $500, right? So what happens is his cash now goes up by $500. Okay, so now he has $1,500 in total, his assets, what he has to use on his business. Now what we need to make sure is we cover that on the right-hand side again, because it has to balance. So what I put in there was, I write a piece of paper, we can forget interest for right now, let's say it's an interest-free loan, and he now owes $500. So his original investment plus 500, 1,500 equals 1,500. Is this following, making sense so far? Yeah.
Yep.
Okay, good. I know, again, it's oversimplified, but I think it's good. It becomes easier as you look at bigger numbers. So we just change the titling around a little bit. So same part in part two, we just say assets, liabilities, and here's the one that will change. It says owner's equity, or it could be eventually retained earnings, shareholders' equity. There's all these different terms, but just think about it, what the investor, my son, has as his original investment, and we'll move from there. So again, we just change the titling. So here's the assets, $1,500. He owes $500 to me. He has $1,000 original capital. Now what he does is he decides, okay, I'm going to take $500. I'm going to go out and buy Legos. So he has $500 less in cash, right? But now he has inventory. So he has Legos worth $500. So what happens is, again, as we look at the left and the right, again, simply we have to balance those out, right? So it's not, the money can't just it doesn't just disappear. It has to tie out. So even if I didn't know, I'm like, where does each thing go? I'm not sure. Again, I know $500 left. I have to put it in inventory, and they balance out. Make sense? Okay, can we go to the next slide? So then what happens is he puts his money on eBay, or he puts his money. He puts his inventory, hopefully he doesn't put his money on eBay. Puts his inventory on eBay, and I put in here, I have been on the wrong end of this deal. I bought stuff on eBay in 1982, Legoland car, police car. Yeah, it happens. So what he does is he sells it for $8,000, okay? So what happens is he receives an influx of $1,000. So now he has $2,000. So what we have to do is figure out, okay, now he has $2,000. The right side has to equal. He still owes me $500. He still has an original $1,000 investment. And this could be called profit, retained earnings, shareholder. There's all these different terms we can use, but the point is he made $500, right? So again, left has to equal the right. Now as we move forward, I go back to Colin and say, hey, remember I was that $500? Well, I need it back. Okay, so as we all can imagine here, right, he has to pay me back. So his cash goes down by $1,500. Now that IOU is torn up. And again, so if I get confused here, as soon as I think through and go, his cash goes down $1,500, I know the right side of this has to equal $1,500. And this is very oversimplified, but I think in the context of when we're looking through balance sheets, it really comes down to this. And I think when we see bigger numbers, we tend to maybe get a little scared, or worried. We see all these different equations like we'll see on the example of JetBlue, but it's the same premise. So if we can go to the next slide to show JetBlue, I believe it is. Well, that kind of blended in the other one, but so on the ratios here, what I did, it's okay, we can still see it fine. So what I do is throw up JetBlue's, again, put in assets plus liabilities equals share owners for shareholders' equity. So this is JetBlue's, their balance sheet. And what I did was I highlighted, as you see all the areas on the left, again, it seems more complex, but yet as I highlight the areas, so for example, I had my assets, I can just go down the bottom and see JetBlue has $9,579,000,000 of assets. And if I wasn't sure, and I can go down to the bottom right there and find the shareholders' equity, and the liability section, you can get a little confused and say, well, okay, there's current, long-term debt. Again, point being here, I can plug and figure out what the liabilities are by just knowing two of the numbers. So even if I'm confused, I see all these current liabilities, construction lease obligations, all these different areas, I can, again, still decipher the number from knowing two of them. One thing I didn't reference on here is short term. So we talk about current, anything that's current versus long term, just think of 12 months. So if I issue my, Colin buys the note for me, the bond, the debt offering, and it's 11 months, that's a current liability for him. If I loan money for 12 months and 3 days, that's considered a long-term obligation. And again, a lot of different numbers, but for the sake of our equations and everything, we're going to be able to decipher this pretty straightforward. Again, if we just know that basic one, we can skip through. We can skip through the questions, Michael, too, if we go to maybe the last slide. I think it's more important, and we can ask questions from there. We go to the last slide. People can look at that on their own. It's the. Can you go 2 forward?
Hold 1 second.
Oh, go back one. It got mixed up. Should I go to the next slide?
That's going to be the next presentation.
Okay, I can resend this. It got cut off, but what I did was I put a little cheat sheet for everyone that I'll send it around to everyone, but it basically has what falls into assets, what falls into liability, and what falls into shareholders' equity. So it makes it very easy as a cheat sheet to say, if I'm ever confused looking at a balance sheet or what should go where is it at, it'll show you exactly each category, and that way you can find it very
Tom,
easily.
you know what? Let me stop my share. I think I can just pull this up again. Bear with me 1 second.
Yeah.
Does
anyone have any questions? Does everyone know this pretty?
You can call on people. I think David's got a question.
Okay, David.
Hey, buddy. Outstanding presentation. Just from a strategic standpoint, which part of the balance sheet, if you're a new CFO, would you tackle first? Which do you think is the most important part of the balance sheet?
Oh my gosh, it would. I wouldn't say candidly, I wouldn't say there's really one. It's going to depend on the ratios. After I look through it, I'd probably have to look at, as we learn, the income statement, statement of cash flows, and balance sheets all tied together. But if there was it's hard to say there's one area, because although liabilities, one area could be inflated, but if the assets match so it's hard for me to say, well, current assets, are the best, or the assets are great, but yet the liabilities are very high, if that makes sense. So I think I really need to look at the
industry and the ratios.
Yes, before I can really gain, but that's a good point. But personally, again, I need to see the income statement, statement of cash flows, and then some of the ratios within the balance sheet before I can, because again, one independently could look great, and then
so it really depends on like the industry and competitive set. So one balance sheet may be good for one industry, but not good for another, kind of thing.
Yeah, but again, if I saw no assets, that could be one clear. If zero is the assets, but then again, then we need to look at the industry too. And there could be companies that are losing. That's one income statement question, but more growth companies are. Eric could probably speak to this, the venture capital side. They're burning through cash, but they're reinvesting in the business. They have a ton of debt, and so it could depend.
Yeah, so kind of like Uber, actually.
Yeah, Exactly. So their balance sheet could look a mess. Their statement of cash flows can make a mess, but they're growing like crazy, tons of debt. Yeah, good question.
Yeah, thanks. Appreciate it.
Okay, any more questions? All right, Tom, thank you for your presentation.
Thank you.
All right, and let's go on to the next one, which is going to be, bear with me one second here.
That was the cheat sheet I was referencing right there.
Oh, this is it?
Everyone's looking at, yeah. So if you ever have questions, just look at that.
Yeah, you want to spend a few minutes on it since we found it?
Yeah, just a quick minute. So two things. So I put a link in there to search for public companies. You can go to the SEC website to get their balance sheet, income statement, statement of cash flows, 10Qs, 10Ks. And then there's also, I think it's called, I can't see the link, but I think it's called GuideStar. But I do some work with nonprofits. So you can look up, you can find, they actually, even though they're nonprofit, they do have to file tax reporting and various, it's not the same as a public company. You can find a lot of information. But again, if you look through here, like I said, you just can look and say, okay, I'm not sure what's a current asset or what's a non-current asset or current liability. But if we just think about it, again, the way I try and learn this is if I'm the business and I have to pay wages to employees, that's a liability, right? And if I have supplies or I prepaid, example of my car, I prepaid my lease, right, for my car, so I pay 3 years. That's now an asset because I don't, I've already paid it. It can go on my balance sheet as a current asset. The one thing it doesn't go through, it says current, non-current again, would be, say, it does a little bit here, long-term bonds. So a short-term bond would be a current liability, a long-term. And then you see that stockholders' equity there. It could be stock you issued, additional money you put into the business. Like that's what you see in a growth company. They'll pay capital in. And then more the value type, more blue chip, we'll call them, type companies will tend to pay dividends. But again, when you have a question, you can just go to here and say, okay, here's what falls in each category. And there's going to be little nuances with every company, but you can pretty much surmise any item, I think, from this chart. So thank you, everyone.
Okay, thank you. And Daniel, before you start on your presentation, I'm just going to stop the share and see if I can play with these slides because they're overlapping on each other. So bear with me one second, everybody. So while I'm doing that, if anyone has any more questions for Tom while I get this together. Okay, I think we're good. Let's get this turned back on again. Try this. I'm going to try to share my screen instead. That might work out a little bit better. Let's move this out of the way. Second here. Okay. There we go. Cross your fingers, everyone, that we got it right this time. Let's try it. Okay. Daniel, are you there?
Hi.
Oh, Jingjin, hi, how are you?
Yes, hi, good. Hi from Singapore. It's 1 a.m. here.
Let me just pull you up here. Bear with me 1 second. Okay, there you go. Go ahead.
Okay, hi everyone, and thanks for Michael for being super accommodating and put forth my slide to present first. Okay, so I'm just going to talk about horizontal analysis. Next slide, please. Let's start off with a little bit of definition of what horizontal analysis is. So basically, it's looking at a company's financial statements and look at how a certain item of the financial statement has changed over time. So when you're looking at a financial statement, you're looking at it across the various columns and making the comparisons across various years, and versus comparing that against a vertical analysis, which is looking at a specific year and taking a specific component and comparing against a percentage of the sales or revenue. So why horizontal analysis is important? This could help investors to determine how a company has changed over time. Is it making more money? Is it, has the sales declined? Is the cost of goods sold increasing or decreasing? So you can start to see certain trends across the various years. And also in general, horizontal analysis can be done in two ways. One is looking at the absolute dollar change, which is defined by amount of item in comparison year, or known as base year, minus of the amount of item, the amount of item in the base year, which means the year that you are looking at, minus the amount of item in the base year. Or you can also look at it in terms of percentage change. The formula is dollar change minus the amount of item in base year multiplied by 100. Next slide, please. So this is an example, which is a public listed company, Coca-Cola. I'm sure every one of us have contributed to their sales in one way or another. And we're looking at in their consolidated statement of income from year 2012 to 2014. Let's look at the next slide. So this is basically the same income statement, but I've added one last column, which is a percentage change from 2012 to 2013. And if you look at line by line items, you start to see certain trends. For instance, the first item, which I've highlighted in orange, net operating revenues, it has decreased by roughly 2 or rather 3%. And then if you look at operating income, which is the next item that's being highlighted in orange, it has dropped by 5%. And as a result, the net income has more or less dropped in proportion to the operating income, which is about 5%. So it looks like, in general, the revenue has decreased, the cost of goods sold has decreased proportionally. As a result, the net income has dropped about 5% from year 2012 to 2013. Okay, move on to the next slide, please. So based on what we have looked at in that income statement, we figure that it looks at both sales and cost of goods, so which is GOGS, have both dropped from 2012 to 2013. And this kind of help us to think a little bit further in terms of what could be the possible reasons. It looks like it's a demand side issue which have led to a drop in demand, and we know that could be few possible reasons. One is could it be is Coca-Cola facing tougher competition from the competitors, for instance Pepsi, or could there be a general change in consumer preference, which could be people are just becoming more health conscious and they want to do away from the basically the unhealthy stuff. And the next question is, what can be done to increase sales? If this is due to increased competition from competitors, is there something that we can do to increase in terms of the marketing strategies? If it's something that's to do with consumer preference, can Coca-Cola increase in its presence and try to come up with products that's slightly more healthy as compared to the standard Coca-Cola products in terms of branch out to other kind of drinks? So this would naturally lead to the next question in terms of what kind of strategies the company can engage to try to increase the sales. And that insight came out from the analysis, the horizontal analysis of its income statement from 2012, 2013. So that comes to the end of my short presentation on horizontal analysis. Is there any questions from the audience?
Please raise your hand, and Jing, you can just call on people.
Michael, I don't really see any hands. I'm not too sure if is it because I'm not seeing anyone.
Tom K raised a hand.
Oh, hi Tom. Yeah, please go ahead.
Hi. Yeah. Is that within you put possible reasons, competition, changing consumer preferences? Is that something? I mean, are there other reasons, or are those just the ones you found, or I mean, are there just various ones it could be?
Of course, thanks for the question. It's a great one. Of course, there could be other types of reasons for why there's a drop in the sales from both years, and these are just some of the examples. We do not know actually what could happen, but it looks like it's more of a demand side issue rather than a supply side issue. And in terms of demand, we could look into possibly competition, demand from the consumers. But of course, there could be other reasons. Is there any other reasons they can think of that would you like to add on?
Thank you. No, that was, I think that's very insightful when you look at, their costs are going down and then your revenue's dropping. So it's very, very insightful. Thank you.
Thank you. Yeah.
Any other questions? Okay, thank you for your presentation. You got some very nice reviews in the chat room. Oh, Jennifer Gillett has a question. Jennifer, go ahead.
Hi, Jennifer.
Hi, it's Gillette.
Oh, Gillette, sorry. I see Jennifer in the...
My question is, I hope it's not kind of off track, but when you're talking about changes in consumer preference, do you think the push that Mayor Bloomberg had in New York to limit the size of a soft drink that that a business can legally sell, how does a company deal with something, that's limiting their sales like that, but isn't necessarily coming from a consumer?
I think that's a very interesting point we should touch upon. I think that is more of a company policy, a change in company policy, or even could be a regulation-driven kind of change that have resulted in a drop in demand for Coca-Cola drinks. And I think one possible way to go around doing this is Coca-Cola actually not only have its signature drink, which is the Coke that we usually drink, but they have multiple brands that's under its name. And some of those can be even mineral water. So they do carry a good variety of other brands. So if there's really about a change in business policy or regulation to cut down on the consumption of Coke, one possible way that Coca-Cola can do is to actually try to boost the demand of its other drinks that's under its brand. Yeah.
Thank you.
Thank you.
Any more questions? Okay, thank you for your presentation. So now we're going to move to Bharath, who's going to also be doing horizontal analysis in his own style. So let's move back to his slides. So we went a little bit out of order today just to accommodate people's schedules. So Tom has something to do, and Jingjin is in Singapore. So thank you for tuning in the middle of the night. I appreciate that. Are you ready?
Thanks. Yep. Can you guys hear me?
Hi, welcome.
All right, appreciate it. So yeah, Jingjin did a great job. So this will be a little bit of a repeat, but hopefully maybe a different angle could shed a little more light. So the way I like thinking about horizontal analysis is that it's another tool in your bag to understand what a company is doing. So for instance, if you had a single snapshot, so Tom, showed a balance sheet, and it gives you a great analysis of a health check, for instance, what the company is looking like right now. So for instance, if I gave you a certain number, right, like 3, that could be current ratio, that could be inventory turnover, and that gives me a great idea of what's going on in the company right now, right? So if it's inventory turnover, this is a good number, meaning that you have consistent turnover, the velocity of products is going out. But what it doesn't say, it doesn't tell you a story. So horizontal analysis, the way I like to think of it is it tells a story. So for instance, if you click one more time, if I give you 2 numbers, right? So I think the slide just builds out a little bit. Yeah, so if I give you 2 numbers, now we can see, we can surmise a couple of things. So for whatever, if this is current ratio or a quick ratio or inventory turnover, we can see there's a change. So if we click once or twice here, so now we can see, okay, now there's a story that we're saying, right? Because now whatever this ratio is, or if it's a percentage or an absolute number, we now have a couple more data points to understand, all right, so we went from 3 to 1 to 3 to 4. So what happened? What's the story, right? So if this is inventory turnover, for instance, was there a event, was there a recession in year 2 that dramatically reduced it? We can start foretelling a couple of things about the future. So next slide. So for instance, the things that we get horizontal analysis, if we get a case or a question that asks us things about trending, about behavior, right? And that could be, like Jing said, competition. It could be different product scapes. It could be the behavior of the management. It could be anything over time, right? Industry regulation, all those things that were brought up. And they could be defined by either absolute numbers, right? Money, for instance, right, is a change of cash balances, or by percentages, which is usually kind of the most interesting point, year-over-year growth or change in net income, right? So next slide. So we took Panera Bread, for instance. So I took it right off the slides from class. And so just to take a quick snapshot of what they look like is we can clearly see that there is a growth between 2009 and 2011, right? So we had about a 14% growth from 2009 to 10, and then a almost 18% growth from 2010 and 2011. So not only does that show growth, it also shows slowing growth, right? Because a year-over-year change, if we take a baseline, it actually, we can see what we call the compound annual growth rate. So the horizontal analysis not only tells us positive or minus changes, but also change in the change. Okay, so next slide. So now if we take just like Jing did, we take a look at each one of the, let's say, pertinent numbers, and I picked a couple of them, is your total cost of goods sold, also gross profit, operating profit, and then income before income taxes. So a couple of things you can tell is from here, you can easily see that, all right, there's been a growth period, but a lot of the things such as operating profit and then things, income before income taxes, have slowing growth. So were there some major investments in capital? Whether, did we have to hire a number of administrative personnel because operating profit slowed its growth from the last couple of years? So now these are the types of questions that horizontal analysis allows you to start guessing, to start asking, answering in a way, in a strategy way. So Jing mentioned, hey, now we can predict what the next steps are and what the strategy of the company is depending on these types of analysis. So that's kind of the way I like to think of it, is now we're asking different questions, not just Snapchat, but asking questions around behavior and transient, which is over time type analysis. And that's what the core of horizontal analysis is. Okay, so I know I took a little bit of Jing's thunder, but hopefully it's a different angle on what you guys had heard from Jing. Okay, so any questions on that?
Thanks, Brock. Please raise your hand if you have any questions. Eric Santos.
Hi. Hey, you mentioned actually you mentioned the full term, but you mentioned CAGR, which is the compound annual growth rate. So that's good you mentioned that, because we're seeing that a lot in our financials, or when I present or look at multiple years, multiple time periods. So it's something that I guess it's not on the ratios list that we're presenting today, but just something for everyone to be cognizant of is the CAGR. because that's looking at the growth rate over multiple periods, not just year over year. So that's just something that I noticed you presented, which was good that you kind of touched on that really quick.
Yeah, no, I agree. The other thing is a lot of, if you look at tech industries now, especially some of the cloud companies and those, they're actually being held more accountable for CAGR because for those, high valuations that they have, they're expected to have that type of growth revenue. So yeah, great pointer.
Thank you.
Any more questions? I'm also going to mention that when you do the WAC analysis on horizontal analysis, be mindful that you have to make comments. So anything that you see in double digits, anything a 10 or higher, is something worth mentioning when you see a 10% change. If you see a 0.5% change or 0.25% change from one year to another, that might not be worthy of spending a lot of time to analyze it. But if you see a big number, especially double digits, I'd encourage you to comment on it, because if you don't, you might get feedback from us saying, something doubled or tripled or got cut in half, why didn't you talk about it? So pretty much the easiest thing to do is anything in double digits, please make a comment on it. And any other questions before we move to the next slide? Okay, Bharath, thank you very much for your presentation and your perspective. Okay, so let's go past Gene's slides. Current ratio, David Swanigan, you're on the air.
All right. Hi, everyone. Can you hear me?
Yes.
Okay, so you can flip the slide. I tried to interject some humor into this, since I'm sure everyone is familiar with the current ratio. So Johnny Bravo wants a loan for his new gym, and his logo is, "Hey there, look at my biceps." Now, if you switch the slide,
okay.
His justification for the loan is simple, because he's pretty. Big biceps, has the tan, has the great hair. So go ahead and flip the slide. So as the loan officer, you could take his word for it, or you really need to dive into the financials. So what you want to know is, does Johnny's gym actually, can they pay back the loan in the short term? And the current ratio is an excellent ratio to answer that question. So go ahead and go for it. So the formula is obtained from the balance sheet, and it's current assets divided by current liabilities. Now, current assets basically are cash or any other assets that can be converted to cash within 1 year of the business cycle. And you heard this in some of the prior presentations, pretty straightforward. It's cash, accounts receivable, inventories, prepaid expenses, and so forth. And then current liabilities is kind of the opposite of that. It's company debts or obligations that are due within 1 year. So accounts payable, the current portion of long-term debt. Now, the focus of this metric is on liquidity. And even though it can't be used as a standalone metric, it really gives someone a sense, does a company have the operating cash flow and the operating liquidity to meet its short-term debt obligations? So if we go forward. So just a couple of things. The key element to this, as I said, is calculated on the balance sheet. Now, a ratio of 1 indicates positive liquidity, so more current assets over current liabilities. Now, the drawback is that it includes inventory. Now, since it includes inventory and accounts receivable, typically it overstates liquidity a little bit, because the quality of AR and the ability to liquidate inventories typically takes a little longer than a year. So as I said previously, it's a great metric just for kind of a sense check on a business, but it can't be used by itself. Now, if we go forward. So here's the example for Johnny's gym. So on the left-hand side, he has $200 cash on hand. He has $100 in membership accounts receivable, $25 sunglasses, and some tanning oil. And that makes up $350 in current assets. Now, his off-balance sheet items are his big biceps and his pretty hair. Now, on the current liability side, he has a BMW, his lease expense for his gym, GQ magazine, and further tanning oil expenses, which surmise $1,000 in current liability. So when you do the ratio, 350 over 1,000, you see that his liquidity, even though he's a pretty guy with big biceps and great hair, the numbers say you shouldn't give him the loan. All right, and that's it if there's any questions.
Roy, go ahead.
Sure. Does it vary? So below 1, low liquidity, does that vary by industry? Like, is it something where in certain industries, would it be okay or normal to have lower or expected lower liquidity?
No, absolutely. Absolutely. And it really depends on the business model. And I think what's great about this metrics is it ties in pretty strongly to the operating cash flow section of the cash flow statement. So based on what someone sells, whether it's products, services, the cash collection cycle, all of these things will give you a sense about whether or not something below 1 or above 1 is good. But I think it's kind of speaks to the original presentation that the industry, the competitive set, really dictates, comparatively whether the ratio is doing well or not.
Cool. Thank you.
Yeah, no problem.
Frank, you have a question?
Yeah, just a quick one. Hi, Dave. So,
hey, what's up, buddy?
Nothing much. Low liquidity. So is this on a certain scale or something? If it's below 1, it's considered low liquidity, or how did you?
Well, and what's nice about this, and you'll hear in additional ratios when you go through the quick or acid ratio, there's some solvency calculations you can do that combine several ratios together. But this really just at a very quick, high level will give you a sense that if someone has current liabilities that are higher than their current assets, what that indicates is they're probably having to take out some short-term loans to pay for those liabilities. Now, that might be okay if they're in growth mode or they're trying to develop their CRM. But for example, if this is a mature company and their current assets are below their current liabilities, you'd wonder why. Is it a reduction in their customer base? Is it a reduction in their quality of receivables, et cetera?
Anybody else? Okay, and also when you look at your wax, you're going to be getting, in some of the material, you're going to be seeing what the industry average current ratio is, and then what the low end and the high end is. So it is going to be separated out by industry, and you'll be getting that as well. Okay, thank you, David.
No problem.
Okay, Ruba, you're on the air. You ready, Ruba?
Yes. Can you hear me okay?
A little louder if you can.
All right, this is any better?
That's good. Welcome.
Perfect. Thank you. Good morning, everyone. I don't think I can beat Johnny Bravo's examples that David gave, but let's keep going. So as a good follow-on to the current ratio, we have the quick ratio. And if we can go next, Michael. So the formula is basically supposed to refer to the current ratio. The only difference is we subtract inventory from our current assets, and then we divide by current liabilities. So a quick ratio is also referred to as asset test. And just to illustrate, it's a good indication of the cash the firm has in relation to its liabilities, what it owes, basically. And to answer also Frank's question, if we have 1-to-1 ratio, this is seen as ideal. If your current asset minus inventory and your current liability are 1-to-1, then that's ideal. But if the ratio was, let's say, 2-to-1 or 3-to-1, then that means that the firm has 2 or 3 times as much cash as it owes, which is healthy because you have more assets than liabilities. But on the flip side, if you have a ratio of 0.5-to-1, that would suggest that the firm has twice as much liabilities as it has cash to pay for these liabilities. So this could basically put the firm under pressure. If we can go next, Michael. All right, so why do we care about calculating the quick ratio? Now, both the quick ratio and the current ratio, they are liquidity ratios. And what that means, they show how solvent the business is, and also measure how well the company can meet its short-term obligations. And we say short-term because, again, both of these refer to the current assets and the current liabilities. So not long-term versus, rather it's the short-term. So as I mentioned, larger values. So if you have higher quick ratio values, that implies that the firm has cash to pay for its bill on time. So low probability of insolvency. Next, Michael. Great. So here I'm giving an example of Chipotle, and to calculate the quick ratio, all what we need to look at is the balance sheet. So we look at the total current assets, we look at the inventory, and then the total current liabilities. So here what I'm showing is basically 4 years, starting from 2013 to 2016. And I just want to show a trend that in the past couple of years, like moving from 2015 to 2016, Chipotle got like a hard hit when it comes to their current assets. We can move to the next slide. All right, so here I'm just giving a like a basic check on how we do the calculation. As I mentioned, it's your current assets minus the inventory divided by the current liabilities. So taking the numbers from the balance sheet, we end up with a quick ratio of 1.5. So if we look at the table, basically for Chipotle, we see the decline basically starting in December 2015 and then more in 2016. And the reason being is given all the recent challenges that Chipotle has gone through, starting from July 2015, the multi-state outbreaks of foodborne illness have prompted some eaters to stay away from Chipotle, and that basically lowered their sales. I'm also giving Panera as an example because competitors basically benefited from what happened with Chipotle. For example, Panera, they expanded their menu of clean food options, and of course they excluded artificial colors, flavors, sweeteners, and all of that. So given those specific reasons, sales and assets were lower in December 2016, starting from December 2015. So that's pretty much it. For now, it's a pretty easy ratio to calculate, and I hope everybody have a better understanding now.
Okay.
Any questions?
Raise your hand, any questions? And also, very nice, Ruba. I also like the fact that this is actually a horizontal analysis.
True, yep.
Nice job.
Thanks.
Any questions? Okay, looks like a clean sweep.
All righty.
Thank you, Ruba.
Sure.
Okay. Next up, inventory. Do you want me to stop this or let it go, Jackie?
You guys can let it go.
Okay.
It's pretty straightforward. We're doing inventory turn. Oh shit! I didn't think it was going to go that fast. Can we backtrack one, please?
Sure.
Sorry. Let's just pause it on that for a second. So we're doing inventory turnover. Its formula is pretty straightforward. It's sales divided by the It's sales divided by the average inventory. Reason you're using average inventory is because it would account for seasonality effects, such as, for instance, very important with things with like retail people, such as Abercrombie or Walmart, which are the examples we'll get into in a bit. Another way that inventory turnover can be calculated as utilizing COGS, which it keeps skipping.
I'll keep turning it back.
It's funny. It's fine. And that just could potentially give you increased accuracy in the calculations. One of the one of the things that it's interesting with this ratio that you can see is the understocking of Abercrombie and Fitch due to the low summer. They're overstocking actually in summer and understocking in other times because that is when they have their high season. And also, in overall, they've been understocking their stores recently because of just lower annual sales for various reasons, as there's increased market competition in the space, and the brand took a hit with, I guess, some of the comments and ways they've been treating their employees. On the other side, there's been a stock shortage of Walmart, and they've been utilizing various inventory analysis to overstock certain items to make sure that they don't run out, as they were able to deduct that this understocking of certain products is actually taking away from potential sales, which now competing with Amazon and all the online distributors has become a big problem. If we go to the next one now, please. Thank you.
I found the pause button.
All right. This is Jackie. The next thing we're going to cover is the collection period. If you can read over there, it talks about the average time that the business gets to recover the money in terms of accounts receivable. Next, please. So next. So the formula is pretty simple. You get the receivables divided by sales, and then you multiply it by the period. For example, if you're doing for a month, then you take the month's receivable divided by the month's sales, multiply by 30 days. If you're doing for a year, you do it by 365 days. So it basically just tells you the effectiveness of the company's credit control and collection efforts. A higher next, please. A higher number would tell you that oh no, we're not collecting enough money. Time to time, we should put some tighter credit controls. A lower average collection number is really good because it means that the organization is collecting payments really efficiently. So there is, I don't think you could see it clearly over here, but in stockanalysis.net, you have the collection ratio for a few companies. It's interesting because I use this for Amazon, but they actually shows the benchmarks of different industry players, like for example, Costco, eBay, Home Depot, Walmart, so on and so forth. So if you look at that website, it actually shows you that Amazon takes about 15 to 18 days to collect its money, while Walmart collects on average from 4 to 5 days. The number is significant because the lower the number, the better it is. So if you have the information, which I think Michael will send to all of us later, you could click on the website and link. You see that Amazon, it has in 2012 it was 16 days, and in 2016 it became 18. So it kind of like extend a little bit longer. So it really gives you some idea on what the company should do to improve its cash flow position. That's all.
Okay. Any questions?
This is Tom. I'm on the line. Can you hear me?
Yeah, of course. Go ahead, Tom.
Okay. Yeah, I apologize. I'm on the phone right now. And in the first ratio, I heard we could use either the average inventory or the cost of goods sold. What would be the reasoning behind one or the other?
The cost of goods sold is just another type of way to do the ratio, and to my understanding provides a little further granularity into the matter. I would say from what I understand is that utilize both, maybe get multiple vantage points.
Okay, but the cost of goods sold would be maybe a little bit more accurate, it sounds like.
From what I've been able to read, yeah.
Okay.
Hey, buddy.
Thank you.
Hey, this is David. One thing when you use cost of goods sold is it takes into account the inventory costing method. So if you use LIFO or FIFO or average cost, so receivables also, depending on how you calculate your receivables. So that's why you do both, because let's say if they use a LIFO method, you know, and then during a period of rising costs, you know, are you putting more expenses on your income statement, or are you overvaluing your balance sheet? So that's one thing to keep in mind with the cost of goods sold.
Oh, thank you.
Yeah, no problem.
Anybody else? Okay, and Guy, question for you guys. What if someone prepays? What would your collection period be? Would it be like 0?
That only measures the receivables and the sales, so it doesn't belong to that period, I believe.
Good answer, Jackie. Okay, any more questions? Great. Jackie, Andrew, thank you. And our next presenter is fixed asset turnover ratio. And is that Eric?
Yeah, it's me, Michael. Yeah, I changed my slide just a little bit based on the professor's comments. They wanted to do didn't want to do average, so I just changed it a little bit. If I can,
do you want me to end this show and give
I
you?
can share my screen and just pull up the changes I made and run through that real quick, and then.
Okay, so I'm going to make you co-host. So.
Well, I should be able to share my screen.
Yeah. So we're
just up to. All right. Is everyone able to see my screen?
Yes.
All right. Good morning, everybody. From Chicago. I'm going to go over the fixed asset turnover ratio. And I'm just going to ask a couple questions kind of throughout this too. Kind of to help me, maybe help some other folks too, because I'm not an accountant. So I'm going to unpack this as we go kind of term by term. So the fixed asset turnover ratio is an efficiency ratio, and it's measuring how efficiently a company is using its fixed assets to generate sales revenue. And fixed assets, there's kind of two things to talk about in there. I think sales revenue is, I think that's pretty self-explanatory, but fixed assets, I want to cover what that means. It's the assets that are purchased for the long-term use. So if you think back to Tom's presentation, a couple other presentations, what we're looking at is we're looking at things that have longer than 12 months before you can recoup, a cash or cash equivalent out of them. So that's property, plant, and equipment, things like that. That's not your short-term liabilities. So we're specifically looking at that part of a balance sheet. The ratio itself is pretty straightforward. So it's net sales revenue over total fixed assets. Another way to look at that too, we talked about in the last presentation, I think Andrew Katz did, is if you want to look as an average number too, you can take fixed assets from 2 time periods or 3 or 4, whatever analysis you're looking at, and do it and just sum those up and divide it by 2 periods or 3 periods to get an average number to kind of see where things are trending. But for today, we're going to talk about just sales revenue over just total fixed assets. So my first question for everybody is this number better when it's higher or lower? Any thoughts? We'll see what people think.
Just raise a hand. Or I can do polling.
We got 1 higher from Teresa, 2 hires. So yeah, higher is better in this number. And this number is more important, especially in highly automated industries, where you're looking to your fixed assets really to be the producers of your revenue. When you look at companies that like technology companies that generally have very low fixed assets, the number just is not as relevant as if you're a security analyst and looking at something that has, huge production lines, and that's a big source of your revenue. So those capital intensive companies are the ones that are really looking at this, and then the security analysts that are investing in them, this is something they really like to take a look at. So I'm going to run through a quick balance sheet example. I think this is, again, this is a good number to kind of figure how efficient something is, but it's not as complicated as some of the other things I think we'll look at today. So we'll take the Harvard Extension School, and we'll look at the income statement. The sales revenue is generally, right there at the top of your income statement. So we're going to work with $94,000. And then we're going to work with, just lost that. We are going to work with this portion of our balance sheet. Again, if you look at, we go on most, I think all balance sheets, maybe if it's different, if it's IFRS, but at least in US GAAP, your assets are kind of listed from your short term to your long term. So when you're going through your current assets, that's not what we're looking at. Once you start getting down to your long term assets, like your PP&E and accumulated depreciation, that's what we're going to use for this ratio. So we're going to have in 2016 is $2,650. If you look at the slide deck that I think Michael sent out, I put 2 previously, so I had a 2015 number. And again, if we were doing average, it's just number 1 plus number 2 divided by 2 or 3 or however many periods you want. But we're going to use 2,650. So pretty simple. It's net sales divided by total assets, and we get the fixed asset turnover. In this case, it's 35.47. So what does that mean? And I want to take a shot at what this 35.47 actually means, if you can describe that in non-accounting terms. I can't tell if anybody's raising their hand.
Oh, Elizabeth, go ahead.
So it's an indication of how well the company is utilizing its assets to generate that sales revenue? So
It is. And kind of more specifically, when you look at this, what this is telling you is every dollar of revenue or sales you're getting, you're going to get $35 out of it, on top of it. That's what that number is telling you, is essentially what your return is for every dollar of revenue generated, what's coming from the assets you have. So I talked about this a little bit previously, but can someone tell me maybe an idea of businesses that have very large numbers? Think of places that do a lot of revenue but don't have a lot of fixed assets to generate that, like law firms, consulting agencies, things like that, where they're not generating revenue based on the buildings and things they have. Any services, right? So Broth is kind of listing off a couple, but yeah, those are the ones that you're going to see very large numbers when looking at the fixed asset turnover ratio. All right. Any questions?
Parath?
Yeah, so just by this, and I think, depending on if it's more manufacturing, but do you think they use this for generally estimating if, let's say, how much revenue I can predict if I open a new plant or, purchase new property, right? So a lot of times, you're trying to guess, hey, a strategy comes to you and says, if we open a new plant, how is that going to affect our revenues? Do you think this is one of the ratios that they would use to calculate that, or is this kind of, are there other things that you would consider for something like that?
Not being an accountant and not really being in this part of the business, I look at I work in private equity real estate and manage a small venture capital fund, so our numbers are a little bit different on the private side, but yeah, I would think this would be something that would probably indicate that if you can take a trend line over, how a business is doing, with what they're doing. In real estate, it's a little bit different because it's very geographically, it's more important to kind of look at the geography, because San Francisco is a different market than Boston. You can't put a trend line on something like that. But if you're talking about maybe a manufacturing business, yeah, I would think that is probably a good place to start. But I don't know if we have anybody that works in that that type of industry that could comment as well.
Raise your hand if you have a comment on that. What I do notice is that Uber drivers could take a look at this, that I have a car that costs so much, how much am I making? Also people that, like we have whale watch boats and people doing tours, tour buses, tour boats. It's always good to take a look at how much did I make during the season versus, what is that piece of equipment costing me? Like, is it really worth being in this business? David, go ahead.
So this actually got me thinking about real estate. So typically on the balance sheet, I believe, is that assets are stated at their historical value instead of their current value. I could be wrong about that, but considering like the real estate crisis in 2007, wouldn't this ratio be overstated if we were to, if you were to use current value instead of historical value? And do like investment firms or private equity firms account for that? I'm sure they do, but I was thinking about that.
We do, but we don't typically look at the historical value, like the going in purchase price and going in cap rates. All of that from an investment perspective, you're looking at net asset value on a quarterly basis. And once you start creating NAVs, that's kind of more typical. If you looked at a balance sheet of a REIT, you could go back historically and look at where that is and see if you've got I don't want to turn this into a whole real estate thing, but if you start looking at kind of cap rate compression or growth in those things and start looking at NAV growth, that's kind of a better trend line piece than this is. But so if you start looking at some of the alternative asset classes, it does tend to obscure, the usefulness for this. I would imagine this is, being this is a very capital intensive kind of look at things, I would imagine manufacturing companies.
Yeah, that's what I was thinking, more so than real estate. Yeah. Okay.
Real estate also, it's hard to, you can't pick, you can't determine net asset value on a daily basis because there's just no way to realistically value, large $500 million, like the Sears Tower here in Chicago. You can't realistically value that on a daily basis. So it kind of loses its value less than a quarterly number for NAV.
And that's helpful. Thanks, man.
Yeah.
Anybody else?
Okay, I'm going to give that back to you then, Michael.
Okay, yep. Thank you. All right, so now I'm going to reshare. Let's see how well that worked. Wow, I didn't mess that up. I'm really shocked at that. Of course, I may have spoken too soon. Okay, so these are your numbers. Let's go to the next person. Okay, total asset turnover. Who is up on that?
I am, Michael. This is Teresa Seacrest.
Teresa, welcome. You are on the air.
All right, thank you. Okay, so this presentation is on total asset turnover. It's similar to Eric's, except for instead of just using fixed assets, we're going to use total assets. And what is a total asset turnover ratio? Well, it's the value of a company's total sales or their total revenue generated relative to its total assets. So it is a big picture asset management measure and is often used as an indicator of the company's efficiency of using its assets. So the formula is total sales or total revenue over total assets. So next slide, please. Okay, so I use Panera Bread in the example since we are prepping this case for our residency weekend. And I use the numbers per the case, which are 2011 numbers. So for total sales, and these are in millions, over total assets, it ends up being 1.77. What this means is that for every dollar in assets, $1.77 is generated in sales. So the ratio can be utilized as an indicator of the efficiency that a company utilizes its assets. And the time period used to calculate this ratio can be either fiscal year or calendar year. The denominator for total assets is typically the average assets over the time period used. So if it's fiscal year, you can use the beginning of the fiscal year and then the ending of the fiscal year assets, and then add them and then divide them by 2. And calendar year, of course, you'd use the beginning of the year, then the end of the year, so forth. Okay, generally, higher ratios imply that the company is generating more revenue per dollars of assets. Therefore, a higher asset turnover is preferred, like what Eric mentioned earlier. Okay, next slide, please. This slide shows Panera Bread over time. So this is one way that you can compare the ratio just over time to see how the company is utilizing its total assets from one time period to the next. As we can see, 2010 it was $1.67, and then it increased to $1.77. So they've improved their asset turnover. This may indicate that the company is using its assets more efficiently, or it may indicate that the company is growing into its capacity, or it can mean that there was a sale of unnecessary assets in anticipation of declining growth. So it actually just helps you kind of get an idea of what to look for, and then what next to look for in a company. So next slide, please. So we're also prepping for the Costco wholesale for this coming weekend. So I went ahead and threw this in here. And their total assets, or their total sales over total assets ratio is 3.32. So it's different than Panera Bread. So it's much higher. So what this means is, again, for every dollar in assets, Costco is generating $3.32 is generated in sales. So that asset turnover ratios are higher for certain sectors. So you can't really compare Costco with Panera Bread. So firms with larger asset bases tend to have lower asset turnover. And it's best to compare asset turnovers within the same sector. Comparisons are only meaningful if compared against competitor companies which are in the same sector. So for Costco, Walmart is in relatively the same sector as Costco. So of the two, which company do you think would have the higher asset turnover? So if you want to take a guess, who would think that Costco would have a higher asset turnover? So you can, I don't know if you want to poll this or just, raise your hand. So who would think that Costco would have a higher asset turnover than Walmart?
Let's do a hand raise. You can also use the chat room.
I think the hand raise would be easier, faster. So how many do we have? Handful? Do you have a handful of hands?
We got one Walmart, two Costcos, three Costcos.
So it looks like Costco has the most. Would you say, Michael?
That's what it's looking like, yeah.
Okay, let's go on to the next slide.
Okay.
So comparing the two, Costco does have the higher total asset turnover. It's 332 compared to Walmart's 229. So a lower ratio could convince the company to try other methods to maximize efficiencies of its assets. Now that's one way it's one ratio to look at. Another one to compare, which is probably closer than Walmart and Costco, would be Home Depot and Lowe's, since they're almost identical types of firms. And as you can see, Home Depot actually has a higher total asset turnover. Okay, let's go on to the next slide. And this next slide just kind of shows you what the ratios are by sectors. And I believe I pulled this off the internet. I think these are the top companies, what their asset turnovers were in their sectors. So for instance, grocery store, the top company might have a ratio of 3.02. And I just put this up there so you can see how they vary depending on sectors. So you can't really compare one company over another if they're in different sectors. And I believe Michael had mentioned that when we do our cases that we're actually going to be given the company averages, so or the sector averages. So that's good, because this wasn't very easy to find on the internet, and I'm not really liking this slide too much, but it's better than nothing. So any questions?
Slim, is your hand up?
Yes, can you hear me?
Yes.
So, Teresa, what's your comment that this ratio is susceptible to the scaling problem that many can see? You've shown that Costco has a higher number compared to Walmart, but apparently, I believe there is a scaling issue in there.
Well, yes, and that's a very good question. But yes, I considered that. But if you can see, it's total sales over total assets. So that should take into account the scaling of the company. So it still shows how well that company is utilizing its assets, their efficiency. So so I think that should take care of the scaling question. If I'm understanding your question.
I guess I should better define scaling. 1% of a million is better than 1% of 10,000. So in other words, if you go back to your slide, there are so much sales on Walmart compared to Costco. So definitely the 2% that shows on Walmart, although it's slower, its profitability, its return in terms of dollar value, it's significantly much higher than the one from Costco. There is a scaling factor in there, and that's what I was referring to.
Right. Yeah. Well, this is like a very, I would say, a broad, big picture asset management measure. So it's just telling how efficiently they're using their assets. So I think that I think the scaling is already in it. Michael, if I'm incorrect.
I think Roy wants to say something. Roy, you want to pop in?
Yeah. So I think scaling is. I think you're right. It's not a matter of scaling, because regardless of how big a company is or small a company is, and the amount of sales they generate, the fact is that you're more or less efficiently managing that that turnover, right? So you can't say if you're bigger, it's going to be harder, but it doesn't necessarily cheapen, I guess, the ratio that you're not doing it as well as a Costco. If that makes sense.
Thank you, Roy.
Yeah, thank you, Roy.
Any other comments? Raise your hand. All righty. Thank you very much, Teresa.
Thank you.
All right. And let's see who's next up. Roy, you're on the air. Welcome.
All right, so we're going to be covering long-term debt ratio. I'm going to preface this whole thing by saying I am not a finance guy at all. I'm in technology and probably don't see as much of any of this on a day-to-day basis, right? So my department has to come in within 5 to 10%, which if you're working in a bank is just shocking. Anyway, let's go to the next slide.
Okay, and Roy, thank you for jumping into the deep end and doing this for us.
Oh, no problem. All right, so long-term debt ratio. The long-term debt ratio defined is really the long-term debt that a company carries divided by its equity. So from a finance perspective, it quite simply is, it measures the long-term solvency or financial leverage of a company. It tells you how much of the company is financed by mature debt, or debt that is older than a year, or will mature in more than a year, right? And theoretically, higher values indicate more risk, right? So let's put that a little bit to the test. So the range that the industry kind of tells us is, hey, if we're, anything more than 1 is high risk. Anything less than 0.4 is supposed to be great, right? So let's take a look at that. Next slide. So, all right, let's define the ratio a little bit more. Let's do a click in the slide. All right, so long-term debt, another click. So long-term debt, essentially all amounts owed for a period exceeding a year. So these are bonds if the company is issuing bonds, any loans or other long-term over a year type things. You can find them in the balance sheet. We'll show you that in a little bit. Equity, let's click on this again, is really just the book value it's your shareholder equity on the that's on the balance sheet. So what this does, when you look at it from just a purely mathematical point of view, click through again.
Okay. One more.
There we go. Is we're kind of looking a little bit into the capital structure of the company and trying to figure out how much of the money that the company earns is financed by long-term debt. Right? Click through. So let's take a look at a simple example. I have company A, and company A, if I go through on a balance sheet and pick out where the long-term debt is and divide that by the total shareholders' equity, I get, in this particular case, company A is 2.45. So this says essentially that every dollar owned by shareholders, $2.45 is owned by people holding the long-term notes or financed by long-term debt. Let's go to the next company, another company really quick. So that seems really high. Let's go with company B. And in company B, if I take a look at this, it gives us a ratio of 0.36. So these are way outside of the initial ranges that I showed you, and they're there for a reason. So just looking at this with a 2.45 on company A, 0.36 in company B. If you had $100 to spend today, where would you put your money? Right, and so I mean, just if you want to just light up the chat, which one seems like a better bet?
Yeah, you could also raise your hand if you want to chat too.
Yep, that too.
And Teresa, we got company B in there.
Company B. Depends is a great answer. All right, so let's just go over to the next one. A was 2.45. All right, so really it says, the question I was asking is company B significantly less risky than company A? So what if I told you company A is actually, so that was the 2016 values for Goldman Sachs. In an investment bank type world, having a really, really high long-term debt to equity ratio is kind of par for the course. In fact, having it as high as 3 is not horrible, and 2.45 is actually really good. So company A, great company. If I told you company B was Barnes and Noble, right? First of all, it's hard to even find a Barnes and Noble out there today, right? But it has a really high for its industry, higher long-term debt to equity ratio than the average industry there. So in this case, looking at this and looking at other factors besides just the long-term debt to equity and looking at it in the context of the industry, it is not really the case that company A or company B is less risky. So let's go over to the next slide. So bottom line, long-term debt to equity measures how much of every dollar in shareholder value is financed by long-term debt. Companies with higher value do run the risk of not being able to pay their future debt, right? And that's why they're considered a higher risk, if you will. But when you're taking a look at this ratio, take a look at the industry and then do your horizontal analysis and take a look at it over time to figure out if this is true value, if you will, of this ratio.
Great, thank you. Any questions? Raise your hand. Roy, I think you sweeped it, Roy.
Sweet, thank you.
Okay, thank you. Let's go to our next presenter. Is this also yours, Roy? Oh no, this is Eric Santos. Case 8, debt ratio.
Yep. Hi everyone, and thank you, Roy. Roy covered pretty much a smaller scope regarding debt. Now, when we look at debt ratio, it's a larger scope. So instead of just looking at long-term debt and specifically over equity, we're looking at total equity as well. So the calculation for debt ratio is total assets minus total equity, and divide that by total assets again. So in short, total assets minus total equity is actually total debt. So total debt over total assets is our debt ratio. So over time, as a company progresses, they might not want to spend all their cash on hand to purchase an item. So they'll finance it through debt. So when we think of debt, it's another word for liability. And overall, debt and liability kind of ensues leverage. So debt ratio is a solvency ratio that measures a firm's total liabilities or debt as a percentage of its total assets. It also shows a firm's ability to pay off its debts using assets. So next slide, Michael. So in this real quick scenario, Sunshine Tours LLC has 61,500 in total assets and 40,500 in total equity. What's their debt ratio? Again, right below that, you see an equation. Assets equals liabilities plus equity. We heard from that in Tom's presentation. So that is, in sense, that's the accounting equation. Now, assets, liabilities, and equity, that's all part of your balance sheet. And when we dig deeper into the balance sheet, we're also looking at debits equals credits. And when we look at debits equals credits, we can think of T accounts. So T accounts is what we use if we've used accounting in the past. We heavily use T accounts to balance everything. And as Tom mentioned earlier, everything has to match. So assets have to equal liabilities plus equity on that side. So looking at this sort of scenario, debt ratio, total assets minus total equity or total debt over total assets, you plug that in, it's actually 21,000 over 61,500. We get 0.34 times or 34% debt. Now, what that means and how we need to relate or understand that is that Sunshine Tours has 34 cents in debt for every $1 in assets. So the lower the number, the better. The lower the percentages is better. So when we start looking at something that's around 0.5 or 50% debt, that is that could be, that could be okay, but it's we want something even lower or less. Because if it's higher than 50%, then we're spending too much. We have too much in debt in regards to our assets. Now, if the ratio is 1%, that's really bad, because that means for the company, it's highly leveraged. It has too much debt in relations to its assets, or it would have to sell all its assets to pay off its debt. So that company is not going to survive. It's not going to make it to the next quarter or through the next fiscal year. So anything lower, we want our debt to be lower compared to our assets. And how do we get our debt to be lower? Then that's where strategy comes into place. We start looking at all the items that's on our pretty much on our income statement as far as expenses. What are we paying for? Can we lower them? Can we buy a cheaper service? Can we buy a cheaper good as a substitute that can get us a lower debt? So that pretty much is the debt ratio, just really simple. Any questions?
Thinagoras, go ahead.
Yeah, great presentation. Just a short comment. You said that the lowest the ratio, the better, which is, I don't think, always the case, because if the ratio is 0, then you have 0 leverage, and we know that with the Mongliani formula that as we increase leverage, the cost of capital decreases, and that's a good thing. And of course, there's a limit because then you have the cost of default and other things. But some healthy leverage is always good to have, I think, no matter what.
Yeah, that's true, because how is your company structured? Is it all capital or is it all debt? We don't want to spend all our cash on hand to make all the goods. Say we need a new truck for our company, we need a new fixed asset to produce items for sales. We probably won't want to spend all our cash because then it'll impact our cash flow, and we'll see that in our cash flow cash flow statements. But yeah, there has to be a balance, and definitely correct as far as we do want to have some leverage. That way we have some debt, but how much debt do we really want to have?
So I have a question for Athenagoras. Is there a Goldilocks ratio for this debt, and is it industry specific?
Is there a what? Sorry?
Is there like a Goldilocks ratio, and if so, is it industry specific? Like 10% debt's great if you're in automobiles, 50% is great if you're in investment banking. Is there other guidelines? Like I call it a Goldilocks ratio. I just sort of made that up. Like is there a perfect number?
I think, as you correctly said, it's industry specific, and it has to do with the structure of each company and its ability to service its debt obligations and not run into liquidity problems and not being able to service your principal payments and your interest expenses. So it is industry specific and company specific. So there isn't, I presume, there are ranges within industry, different types of companies where it has been shown that this is the leverage that these companies have been sustaining and has been healthy. Of course, there are periods in time where the whole financial system is over-levered or under-levered. So that's also another, from a macro point of view. But I would say so. It's my answer. Yeah, there are ranges, I would say.
Okay. Teresa, I see your hand up, and then Barath.
Yeah, my question just relates to the same thing. If there wasn't any industry, by industry ratio danger point, is there kind of a universal one where, let's say that one that we know is bad, but when it creeps up above 50, is that something we should be looking at?
Yeah, what they say is 0.5 is pretty much where it's pretty much half. So 0.5, debt is 50% of assets. They say they're fine with that. But then again, they're looking for something that lowers the better. And again, it's going to be up to each company specific. I can't say per se that I've seen anything industry specific or sector specific for debt ratio. It's pretty much what the company is going to be comfortable with. Say they have a 0.2 debt ratio, and they're thinking about purchasing another truck, for their business, for delivery. Are they going to finance it through all debt? Are they gonna do half, pay half of the cost in debt, and the other half they'll pay cash? So that's something that they'll work with their finance team, their strategy analysts. Okay, what are we going to be comfortable as a company going forward if we are going to buy a new truck?
Thank you, Eric. Barath, you're next.
Yeah, so I'm just musing, but it seems like, not just industry, but if the higher return on assets ratio you have, I think you should be able to leverage a higher debt ratio. So if you take a look at like Goldman, right? So they have a very high debt ratio. Well, for every leveraged dollar, they're able to make more money. So that gives them the ability to have, the better the margin, the better ability for every dollar to create more revenue, right? So let's say for auto industries where they probably have a lower return on assets, right? Maybe whatever that number is, every leveraged dollar will make less, so they should probably be leveraged less. And that kind of goes, with general theory, right? So, hey, I shouldn't be as GM or Ford, I shouldn't be 1-to-1, debt rate, 50% debt ratio for any downturn. So I think that might be a good litmus test, just kind of musing on what some of that Goldilocks number would be.
Yeah, Barath, that's good because, to get your debt ratio, looking good, you can either raise your assets or pretty much kind of look at lowering your debt. And this is just one thing for those in the banking or industry, investment banking. The components of the balance sheet items, assets, liabilities, it's sort of flipped. So what's an asset for a regular entrepreneurial company is going to be differently for a bank. I don't want to confuse anyone, but it's kind of sort of flipped on that side. Do you see that too, Barath, as far as what's an asset for one company is not an asset for a banking institution?
Yeah, and then that's kind of general, right? Because even if we say, let's say software, right? Because you don't software is just downloading let's say Snapchat or Facebook. There's not real assets. It's more of like services, consultings. But if you did take like a comparison, you could say, let's say, return on employee asset, something like that, or return on labor, for instance, and that would also be a good litmus test, because for, let's say, manufacturing, your return on, let's say, employee labor is going to be lower than a return on employee labor for like a Snap Inc. when they go IPO, right? So that could also tell you that your leverage could be a little bit more because of that. Something, there's some, I don't know, I'm using here, but you can kind of gather information that way, I think.
Yeah, and for software companies, they're going to look at assets from, patents, anything copyright, goodwill, technology. That's really going to where they're going to get their assets from regarding software development versus the expenses on what's costing them to market and promote.
Athena Goris, your hand's up.
Yeah, I was going to say I agree with all of these points, and I just had a look at some statistics to see for each industry. So basically, there are ratios for each industry from top to bottom. So you have like the highest ratio. This is for U.S. firms, by the way. So for conservative financial services, but for the financial services category, you have on the 90%. Debt to assets, and the software and programming companies are like at about 5%, and the average of all U.S. firms is at 30%. Just so we have some perspective, of the ratio. Just that.
Oh,
do you have real estate or real estate development? Because I used to invest in that, and those guys leverage like crazy. I was wondering if anyone has any numbers on
real estate is at 55%.
Yeah.
But again, it's the average, so we don't really know what. It's the average, yeah.
I think some of my bankrupt real estate developer friends were a bit higher.
Probably.
Okay. Any other questions before we move on? Eric, thank you for your presentation.
Welcome.
Okay.
It's me again.
And look, it's Eric Santos yet again.
Hi, everyone. So this one is times interest earned ratio. So the last one we looked at were components of the balance sheet. Now times interest earned ratio, we're looking at, or the components that's key to this are from the income statement. So the income statement in a nutshell is your revenue or sales minus expenses, and that'll get you your net income or net loss. So that pretty much three components: revenue minus expenses to get you your profit, or net income, or profit. Another term for profit or net income is earnings before interest and taxes, or EBIT, EBIT. So let me take a step back. So times interest earned ratio is equal to your earnings before interest and taxes, or EBIT. Again, it's just E for earnings, B for before, I for interest, and T for taxes. I mean, you could go further, and it's EBITDA, and you could also include depreciation and amortization. But in this sense, it's just earnings before interest and taxes. So if you took out interest and you add it back in, so that's going to be divided by interest expense. So overall, in the box below, it's times interest earned ratio is a coverage ratio that measures the proportionate amount of income that can be used to cover or pay your interest expense in the future. It's also considered a solvency ratio because it measures a firm's ability to make or pay interest payments. So pretty much all throughout this this whole Web 6, we've been looking at the ratios as far as, is this ratio going to, allow us to see, can we pay, what we owe? So this one is can we pay the interest expense? So where do we get interest expense? That's pretty much from our loan. So if you do take out a loan, say you do increase your debt for your company, you're going to have an interest. Bank's going to say, we'll give you this loan at 10%. 12%. So that's the interest expense at 12%. Can you pay that interest expense over time? So next slide, Michael.
Sure.
So this one, we're looking back at Sunshine LLC. You know, it's a fictional. It has 88,000 in EBIT and 20,000 in interest expense. So their times interest earn ratio, you know, looking at it again, EBIT over interest expense, 88,000 over 20,000 gets us 4.4 times. And below that, it's Sunshine Tours can cover their interest expense payment 4.4 times over, which is good. So pretty much the threshold is 2.5 times. So anything at 2.5 times is a warning sign. Anything lower, you know, the company could be at risk of not being able to pay their interest expense when it's due. Now, right here in this example, 4.4 times, 4.4 times over, they can pay, you know, their interest expense, which is good. So they, you know, can definitely cover that interest expense when it's due. So right there, I'll end it, see if there's any questions.
I have a question. Just tell me if I'm looking at this the right way. So let's say that I own this company and I'm seeing this 4.4. Could I, as an owner, say to myself, okay, I can make 4.4 debt payments before I'm in trouble. So I have enough cash where I could pay for the next 4.4 months.
True. That's another way. Yes, that's definitely how you can look at it. You're 4.4 times over, and then you can cover your expense 4.4 times over, or, you know, if it's due each quarter, you've got your year covered pretty much.
So, okay, so if I'm at 12, I'm good for the year. If I'm at 1, I can only pay this month, and then I'm in trouble.
Yeah, and then you would be like pretty much scrambling to where am I going to get the cash, or how am I going to pay this next interest expense payment? Now, one thing, okay, because I'm in Las Vegas, Nevada, and when we look at the casinos here and how they're sort of leveraged, we can think of something recent is Caesars Entertainment. So Caesars Casino, they declared bankruptcy like how many years ago, and it's a restructure payment. So you can imagine as far as how much debt that they're incurring, and for their debt payments, I mean, just their interest payments alone to cover their debt is in the millions. So if they're not if they're not, you know, receiving the revenue that they're expecting or forecasting, the sales, as far as, you know, the gambling and so forth, they've been hurting. They weren't able to pay their interest payments. So they, you know, fell into bankruptcy, restructure, you know, and so they can find a way to make those payments, or again, in bankruptcy, pay, you know, pennies on the dollar what's owed. So that's something to consider. How much debt am I going to incur? What interest rate am I going to receive? Don't shop around. Bank X will give me, you know, this loan at 10%, but Bank Y will give me a loan at 5%, but with all these other conditions. You know, I'd rather have a smaller interest payment than something large, or, you know, depending on what the conditions are against that loan.
Great, thank you. Elizabeth, I saw your hand was up. Did you still want to say something?
Sure, I just had a clarifying question. I thought you were talking then about the 88,000 being an annual earnings before interest and taxes, and the 20,000 being monthly, but that's not the case, right?
Yeah, it's just a really high level. I'm not breaking it down into monthly or quarterly. Yeah.
But presumably, if they're making this 88,000 in earnings annually, and that interest is 20,000 annually, it's not the good performer on months, Michael, right? Oops, sorry, I muted myself. They're set for all year.
Yeah, well, it'd be 4.4 times over pretty much 4 years. They could cover their payment over 4 years. So again, it's just something simplistic. Yeah.
Yeah.
And then just a clarification question, Eric, that you have to be dividing same time period to same time period. So annual divided by annual, monthly divided by monthly.
Yeah. And that's one thing, again, just a I'm going to go back as far as when we look at balance sheet items, this is your assets, liabilities, and equity, your owner's equity. And we've heard throughout the course, throughout this Web 6, is that it is a snapshot in time. So one thing, that I learned over the time regarding balance sheet items is if you think what's in your wallet or purse right now, so if you reach in your back pocket and took out your wallet and you find that you got, $30, that is your snapshot in time. Now, how did you get to that $30? Well, over the past week, my brother gave me $20 that he owed me. I paid, $10 to my sister. I paid $5 over, for a quick lunch. That time period of that week is your income statement. So that's where, again, it's a balance sheet snapshot over a period of time from point A to point B. And in my example, as far as what's in my wallet, it was a week from Sunday to Saturday is all the transactions that occurred. That's your income statement. And again, when you look at these ratios, you do want to cover same time periods over same time periods.
And Richard Hom, I see your hand up.
Hi, Michael. Eric, very good presentation. I just want to mention the casino point. And you're right, with respect to the casinos, my experience was I was working for a large European bank at the time, and they had lent a lot of money to various casinos in Nevada, and one of them had to be. I was working for actually Deutsche Bank, and prior to joining Deutsche Bank, I was at UBS, and I saw a proposal come across my desk where a developer was looking for a $4 billion construction loan to build the Cosmopolitan. We had a bit smarter bankers at UBS at the time, so UBS actually passed on that, but Deutsche Bank did it, and obviously they lent that money at a high interest rate. Prior to the crisis, they defaulted. They obviously couldn't meet their interest payments, and then Deutsche Bank ended up owning and running the Cosmopolitan Hotel for a number of years. That was actually held in their bad bank before it was actually purchased by Blackstone. So it's a good example.
Yeah, so thank you. I mean, for all of you who do have money and do want to open up a casino, by all means, just Vegas is always looking for investors. I mean, there's one new casino that's in development. It's Resort World Las Vegas. It's from Resort World, which is based out of Malaysia. I'm not sure if Jackie, you're in Singapore, you probably heard of Resort World because they have operations in New York, and I think Singapore, and throughout, I think UK. They're all over, and they're the next largest casino that's due to open probably within the next 2 years. But again, it's these casinos. How do they operate, and how do they, incur the debt that they need from investors to build? And then they look at the operations where times interest earn ratios. They're going to be cognizant of that to make sure that they can pay back the banks, because their loans you have to be, thinking are going to be quite large.
Okay, any more questions before we move to the next person? Eric, thank you very much.
Thank you.
Okay, who's next? Blanca, you're on the air. Are you with us, Blanca?
Yes, I'm here. Can you hear me?
Yes, how are you?
Good, thank you. You?
Good, welcome.
Thanks. Okay, let's start. Profit margin. Yeah, so profit margin is as a formula, is the net income divided by net sales. Income as revenue minus expenses. In expenses, you can put all the expenses that a company may have. It's a profitability ratio, and it's expressed as a percentage. And basically, it measures how well a company manages its expenses relative to its net sales. And another way of seeing it is how much of every dollar of a company in the sales actually they keep in on the earnings. So here you want to get a higher ratio, as high as possible. how to do this. So you can either generate more revenues while keeping your expenses constant, or you can lower your expenses while keeping your revenues constant. So as generating revenues is one of the, I would say, most difficult thing to do for a company. What do you do? What do managers do? So they tend to reduce the expenses and cut budgets to improve the profit margin ratio. Also, if it's too low, that would indicate that your expenses are too high, and then you have to, of course, reduce your expenses. So if we go to the next slide. Okay, I took the pharmaceutical industry because that's my industry. So basically, according to Forbes, 20% is the standard in the industry. And I took here Johnson & Johnson, which is actually the first one in the category. So I took the net income that you can see it at the end of the presentation in one of the annexes, but I just put here the figures so that you can see. So as a net income, Johnson & Johnson, in the annual report that is published on their website, they had a bit above 15 billion in sales. In the net income, the sales were 70 billion, and so if you divide the net income divided by the sales, that's at 21.99. So basically, they earn 22 cents, a bit less than 22 cents per each dollar that they have of sales. So it's above the industry average, but just to give you another data. So for example, Sanofi is one of the companies that has less, and they have an 11%. Why that can be? So it's in the case, for example, of Sanofi, their sales are not that high, but also their expenses are quite high due to that they invest a lot in R&D and in creating the pharmaceuticals that they sell. If you go to the next slide, here you can see, well, all the resources that I use for the presentation, and in the next one, you could see, here, basically their statement that came from the annual report. And in the next one, that's just a snapshot of the different pharmaceutical companies and what their profit margin is. So just a comparison for you to know. And that would be the end of the presentation.
Okay. Thank you very much, Blanca. Raise your hand if you have any questions. Okay, I think you're good. Blanca, thank you very much.
Thanks.
And boy, Pfizer, 43%. Jesus, I wonder if drug dealers make that kind of profit margin. That's huge. Well, literally, they are drug dealers, actually. That's
really huge. But Pfizer, one of the things they did is that they grew a lot through mergers and acquisitions. Mm-hmm. So they incorporated to their portfolio a lot of different drugs that sell quite a lot without having the expenses of developing them. So that's really why the ratio was that high.
Oh, interesting insight. Eric just raised his hand. Eric, go ahead.
Oh, thanks, Blanca. Just, sharing with us your I guess, association with pharmaceutical companies. Just, one thing that's also leading to their sales is just in the past year, they've increased a lot of the drug products. So their markups are pretty substantial now. That's causing a lot of contentious attitudes as far as consumers, not being able to afford the new pricing that some of these products, like for example, the EpiPen, that's now costing consumers like 3 times more than what they were normally paying. So that's just one way for pharmaceuticals to increase their sales is to mark up on their products.
Yeah, that is really depending on country to country. In some countries, you really cannot go as much high as you want because there's the reimbursement. I know in the States it works different, and a lot of companies do really increase the prices a lot. But in other countries, that's not the way it works. But yeah. It's really also how they make the money. Yes.
So, do you recommend us buying our drugs from Canada or someplace in Europe versus US?
Yeah, of course. I mean, here it's much cheaper in Europe than in the US. The drugs, yeah.
So awesome. Thank you.
Thanks, Eric.
Any more questions for Blanca? All right, Blanca, thank you for your presentation.
Great, thanks.
Salam, you're up.
Hey, thank you. Well, I will cover the easiest one, I guess, return on assets. It's basically a measure of profitability, and it's to look at how well the company is handling its assets to generate income. The equation to calculate it is basically net income divided by total assets. It comes from 2 of the 4 main sheets in accounting. One is the balance sheet where you get the total assets, and the other one is the net income, which comes from the income statement. The second slide, please. The second slide, I'm showing Chipotle. I love Chipotle, that's why I brought it back. Basically, I'm showing on the left-hand side the balance sheet, and on the right-hand side the income statement. You can look at the net income way at the bottom. It's 22,938. This is in thousands, so it's actually 22 million. That's impressive. Divided by their total assets, which is 2,026,000, and you're going to end up with a percentage that's equals to 1.13%. Now, this is a low percentage if you want to compare it to others in the same industry, like McDonald's, which used to be the parent company of Chipotle back in the days until they sold everything. Now, McDonald's return on assets is close to 12%. You can see that McDonald's are managing it better, but it's not actually that only because they owned the Chipotle at one point in time, and they are the one who put Chipotle on the right track for success. What happened is that Chipotle had a tremendous loss of customers, and they ended up having to increase their cost of goods sold, cost of revenue, because of the foodborne illnesses that happened. They got like 9 foodborne illnesses in just like a matter of a year or maybe 2 years. So the company had to go to drastic measures and increase their cost to generate the same plate. They did not increase the price because they still want to bring back those customers, and that's pretty much it. So you can see it's getting lower. Now going to the second slide, please. Now the people, as in all ratios, people debate how you should calculate it. With the return on assets, they basically say, since the total assets has an element of debt in it, so it's not only it's not only equity, there's an element of debt, so you need to factor that in your net income. Now, if you want to look at that, then basically you need to take your net income and add the interest expense to it. And when you look at the total assets, you don't look at the total assets, you need to look at the average total assets. Now, the people are also still debating this approach because they're saying if you are adding back the interest expense is already factored in the net income in another fashion, which is basically in the taxes that the company paid. So basically, if the company is paying more interest, then they end up paying less taxes. But regardless, this is where most of them are agreeing on the way the proper way to calculate the return on assets. Basically, net income plus the interest expense divided by the average total assets. So if we go to the next slide, please. I'm putting here Amazon, my guilty pleasure. You need to deactivate this one button buying thing that they had. Ended up spending $300 last night. Basically, if you look at their income statement, you need to look at the one from 2016 and the one from 2015. So the average basically is taking the one from 2015 added to the one from 2016 and divided by 2. And your return on assets for 2016, you take the net income and you add the interest expense to that, and you end up with a percentage that's 3.85%. Now, if you want to calculate it differently, the way that you would see on Wikipedia, basically the net income divided by the total assets, you end up with a percentage that's close to it. It's 2.84%. So it's not that they are drastically far away from each other, but the recommendation is basically that you do it the top way. And that's pretty much it for return on assets. It's simple and straightforward.
Okay, any questions for Salam? That looks easy. Okay, Salam, thank you for your presentation.
You're welcome. Thank you.
Next, Jalal Haddad, you're up.
Yeah, can you hear me?
Yes, we can. Welcome.
Okay, so this is also the same concept. So basically, I chose AT&T. So first, as an introduction, AT&T is the second largest telecom company in the United States after Verizon. By end of 2015, its total assets were around 400 billion, which are mainly composed of fixed or non-current assets. And you can see down in the charts, you will see that 91% of the assets are basically non-current. And if we break those down, we see that they are mainly constituting of PPE, and there's quite some goodwill from acquisitions and licenses. So that's basically the bulk of the assets of AT&T. It's worth noting that this was an increase from 300 billion. So within 1 year, they increased 100 billion in assets. Okay, if we can go next. Just a bit slow. Okay. So the way I always like to visualize, because it can tell many things at the same time. So what I did here is I plotted the ROA of AT&T and its two main competitors, so Verizon and T-Mobile. And you can see on the table on the right that basically AT&T was a primarily leader in terms of return on assets up until 2014, and then it became Verizon. One thing that's interesting to notice, I could have chosen T-Mobile as the case because it's a bit interesting. They had a huge drop starting the last quarter of 2011 and for the full year of 2012, where they actually lost 700,000 customers. Within one quarter, they lost a huge amount, and that is basically because they did not offer a package for the iPhone 4S. And that made a huge difference. And you could see for T-Mobile that a small strategic mistake can be very costly on the long term, even though they came back, but they need, of course, to recuperate all the losses that they have made during that period. The peak for AT&T was in 2010. They reached 7.39%. Okay, so this means basically for every $100 of assets that they have, they generate $7.39. Okay, the 10-year range is between 1.46 and 7.39. So we have more or less for this kind of industry, what is the range, and the average is around 4%. Okay, if we can go to the next page. So here I selected, I charted basically the different sectors. Maybe sector is a better term than industries because there are many industries within the same sector. So what we see is between the different sectors, basically the ROA ranges from 1%, which is the financial on the left, up until 8%, which is the consumer non-cyclical products. And with an average of 4% it falls pretty much in the middle. One thing that is interesting with ROA is that we talked before about the turnover asset ratio. And turnover asset ratio basically explains more the efficiency of sales. And within the same industry, if two companies are relatively mature, you will not have a big differences among them because it's pretty much related to the market and how you deliver to the market. However, in ROA, you have the element of operating expenses and all the expenses, the fiscal expenses, etc., embedded, and there could be a lot more possibilities for differentiation in terms of competitiveness in this case. So even within the same industry, within the same geography, same customers, and so forth, you could still have two companies that one is much more efficient at generating actual hard cash, basically, versus the other. So that's all. Are there any questions?
I have a question, Jalal. Take a look at the financial sector, 0.94%. I'm curious how that number could be that low. Any thoughts on your end or anyone else?
Well, I think we have to look deeper because financial is a big umbrella term here. It's a sector. Maybe inside the financial you have a big variation of different industries. I could think, for example, of a bank where basically what they make in terms of return is the interest rate. So they have to have a lot of assets that are loans, bonds, and so forth. But what they generate eventually are the interest rate, and they could be quite small. But that's on top of my mind, basically. For other types of firms, investments, etc., I'm not sure.
Okay, thank you. Eric, I see your hand is up.
Yeah, I just want to corroborate regarding the financial at 0.94% because I'm with a bank, and for our retail division, our ROA target is 1.5%. So this is pretty much in line with what our target is. And for the banks, or at least our bank, we tend to normalize our ROA because of the losses that we incur from a lot of the credit losses. Yeah, so because of the credit losses, we adjust our ROA to normalize it, and it kind of gets us a better read on ROA.
Is your number low because you have brick and mortar?
No, it looks at the assets. It looks at when we normalize, we look at the credit losses. We take a percent of that losses and we adjust the ROA. And also regarding the assets, what does the bank have in assets? We tend to joke that the long-term employees are our fixed-term assets because they're there forever. Yeah.
Michael, your microphone is muted.
Okay, thank you for letting me know that, Jalal. I think we're all set. Thank you for your presentation.
Thank you.
And next up is Richard Homan.
Great. Hi, everyone. So I'm presenting on return on equity. And as you can see in the slide here, return on equity is one of Warren Buffett's favorite numbers. And return on equity is simply net income that a company generates in relation to the amount of common shareholders' equity that the company holds. It's an important measure because it illustrates how efficiently the company actually utilizes its common shareholder equity. You can see in the formula, return on equity, is simply net income, and again, it's based upon its after-tax profits. And its shareholders' equity. It's important to note that return on equity, it's computed for common shareholders' equity only, so it doesn't include preferred, so it's a common only. It doesn't include the preferred shares and it's net income based upon the full fiscal year. One other important thing to note about return on equity is that common shareholders' equity is based upon the average of the beginning balance and ending balance. So you're looking at your net income over the course of the whole year, and you're taking your average common shareholders' equity over the period, and that average period is based upon the starting point and the ending point. Next slide, please. So here I've got an example. Sorry that the slide actually got a little mixed up here, but in any event, I can walk everyone through it here. So in this particular example, we've got Source IT. They're a distributor of software products and services. Their net income was $5 million. Their shareholder equity, the average shareholder equity was $25 million. So the ROE is simply 5 million divided by the 25 million, or 20%. And in this particular case, again, net income is based upon the 12-month after-tax profits, and the shareholders' equity of 25 million represents the average of the beginning and the ending year shareholders' equity. On the right side of the slide, we've got an illustration, and it shows that Company A has got a profit of 50 million, and Company B has also got a same profit of 50 million. And so the question is, and well, you can see also that one company has got 1,000 shares, the other company has 10,000 shares, and one company's worth, each share is worth $10. Well, actually, in both instances, each share is worth $10, and it's so it would be a great either company. It would be a great. I'd love to own shares in this company for $10, or either company for $10, but one is actually more attractive than the other, and you can see that a company A that has a profit of 50 million on 1,000 shares is that's got a much higher return on equity than Company B, which has a profit margin, the same profit of 50 million on 10,000 shares. And then, Michael, can you take us to the next slide? And so the next slide really is an illustration to say that return on equity, it's a profitability ratio measure from the investor's perspective. So it measures the amount of money that's made from the investor's equity investment. It's often calculated over multiple periods. So just like on the last presentation, we saw that return on assets, we saw the different trends for AT&T, Verizon, and others per annum. Return on equity is also looked at on the same period to track performance and a company's ability to really sustain those trends. And it's also useful for, obviously not only to look at the company on an individual basis, but obviously look at the performance of companies over the same industry. It's also important to note, and the reason why I added this particular illustration as the third illustration that says, does your business make real money? We do make money in our books, and this is really to drive home the point that return on equity, it's based upon all the assumptions with regards to regards to accounting, and this is book return on equity. It's not return on investors' equity, and investors' equity is different from book equity, because investors' equity shows how much are you actually paying for a share of the company, and what is your return based upon the actual price you're actually paying, as opposed to book. So that's just one distinction, and there are many important distinctions to know about return on equity. But that's it.
Okay, thank you, Richard. Raise your hand if you have any questions or comments. Athena Goris, go ahead.
Richard, I loved your presentation, especially the book versus market value of equity, which is really important to know. So just a couple of points. We have to take into consideration always, I think, the level of debt the company has, because that can very easily affect return on equity. If you have very high leverage, you can you can boost ROE very easily. So we have to, when we are comparing, as you correctly said, within the same industry, two different companies, it's good to also see other ratios such as leverage ratios. That's one comment. And the other comment is that this ratio, of course, is affected by the value of equity. So we have to also see what's happening with that value over time. So if you have any write-downs or share buybacks, you can that can boost the return on equity. So it's good to always see what else is happening. So just those two comments to complement a great presentation.
Oh, well, thank you very much. Just to reinforce what you've said with regards to leverage is really a very important consideration. I'm investing in Bank of California, and they've got both common shares outstanding as well as preferred. And so by just having both preferred and common, preferred actually leverage your common, above and beyond your actual debt leverage. So that's one point. And with regards to the market value, and a lot of, let's say, banks will, historically in the past they've traded at let's say 2 times book value. And now, most recently they've traded at book value or slightly under, but obviously with the new administration and all the potential changes in financial regulatory reform and tax reform, we're seeing the valuation in the financial sectors increase quite a bit. So market value.
Okay. Any other comments? Questions? Richard, thank you very much. All right. Aritro, you're up.
Yep. Hey, can you hear me?
Yes.
All right. I have to say, touche, Michael, on that illustration. I also had it on my slide, and we didn't really collaborate on what we were doing with each other's slides. So I had the same illustration and the same thoughts on on whether where we make the real money. So I'll skip that part and skip the general updates that Richard already gave. But it is an important ratio, that's widely used by investors. It's one of the indicators of how well the company is performing. Also, keep in mind, as some of you already mentioned, that this is not this should not be the sole indicator to for you to come up with a decision as to whether an investment looks lucrative or not, or how or how it might describe the financial health of the company. In general, I did a case study on HP. I'll talk about that in a bit. But in the technology sector, analysts consider an ROE in between like 10 to 20% a good attractive range for investment. A steady or an increasing, return on equity, signifies that, that a company basically knows how to reinvest their earnings. And this is important because a lot of the technology sector, companies, they retain their earnings in the equity of the business. A declining, ROE is, of course, it's symbolic that the management has not been effective in the way they've been, reinvesting their own capital in successful assets. Again, however, keep in mind that this, apart from not only looking at just this particular ratio, ROE should be looked at over a course of time, so over a course of a few accounting periods. That would give you a better understanding of where it's trending. Because oftentimes companies can post a negative return on equity, which is not necessarily a bad thing. A declining trend is, can be a bad thing, but not necessarily a negative return. That include, that pertains, understanding a company can post, a negative ROE, depending on what stage, what life cycle of the business is the company in. So, for example, startups will almost have a negative return on equity because they're a new business, and making returns on the equities, will take time for them to be, to actually post on the statements. Some mature companies can, some more mature companies can actually post a negative ROE, but that could be because this is an accounting metric, and it has to take into account, let's say, R&D expenses, which could impact the net income, which in result impacts the ROE. It then might post a lower ROE or even a negative one. What I did was, just for HP, I was actually trying to find, a company that went from posting, almost a 20% ROE in 1 year to the next year going down to almost a 60% negative return on equity to, coming back to almost a 25%. So, I thought that spike was pretty interesting to take a look at. And what happened with HP was back in 2012, they they made a bad acquisition of a cloud computing company. I think it was called Autonomy, or I believe it was called Autonomy. So what happened was they acquired the company, and later on figured out that that particular company was actually cooking the books. So that, along with they had headcount reductions and writing down that goodwill, that almost led them to post a negative income of almost like $14 billion for that year. Does that really, did that really mean that it was a bad investment for that year? Yes, if someone went in and out on the same year, yes, it was. But as I said before, that over ROEs is a ratio that should be taken a look over a course of time. And you see where it came back in 2013. It was back up again to like positive 25%. So just looking at one particular time frame, one particular accounting year can be misleading. So it's good to get a horizontal analysis, as someone else presented earlier, or to have over a holistic view of a few accounting cycles. That's that's it from me.
Okay, thank you, Aricho. Any comments, questions? Raise your hand. Beautiful. Okay, thank you for your presentation.
Thank you.
Next up, Athena Goris, you are on the air.
Hello, just give me 1 second.
Sure.
Okay, so first of all, I loved everyone's presentation. Very, very good points, everyone. Just a couple of generic points on that. Just want to say that because my section is very different. I think the break-even analysis is not. There's no ratios here, or not so much though. My general comments relate to the use of those financial ratios. I think they never should be used in isolation, and they always should be used as evidence to answer some questions that we might have for the company. So basically, we're trying to come up with a story of why is that happening, or what's going to happen in the future. So what is the underlying story? And we're trying to find meaning using the ratios as evidence, basically. And so yeah, we do that. We can do that cross-sectionally or even over time. So that's the general comments. And the break-even analysis is a very useful tool that can answer some very important questions that someone might have about the company. For example, at what level of sales will our company start making profit? So that can be the point in terms of units sold. It can also be the point in terms of sales in dollars. And another thing that we would like to know is, when will that happen? So is it going to happen in 6 months? Is it going to take a year to break even, etc.? So basically what determines the break-even point is the revenue and expenses relationship. So we want to know, as sales increase, how do expenses behave? So as we all know, there are fixed expenses and variable expenses. Like in economics, we say fixed costs and variable costs. So fixed costs don't change with output. So these are costs like rent, interest expenses, utilities, etc. And variable costs are directly related with output, like the cost of goods sold. So I just came up here with a very simple example to for representation purposes. So we have an ice cream stand, and we are selling, like, our product is the ice cream, the cone with the ice cream ball, strawberry ball. So that's what we're selling. And let's assume we price that at $2. So of course our total sales are going to be $2 times the quantity we sell. And let's assume the variable cost, so the cost per unit is 50 cents. So since we know the price per unit and we know the variable cost, we know what the contribution margin or the gross profit per unit is. So that's $1.5 per ice cream that is sold. So if we know that, we would like to know, okay, what is our fixed cost? Like what expenses do we have during, let's say, 1 month period? So given that, how many units do we have to sell to cover our costs? So this is, as you can understand, it's a simple division. So let's assume our fixed costs are $1,500. So we simply divide 1,500 with 1.5 to get to the break-even point in terms of units, which is 1,000 units. So if we want to arrive at a sales figure, we simply have to multiply that with the price of each unit, which is $2, which gives us $2,000 in terms of sales. And that is our break-even sales for our ice cream stand. Again, this is just a fictional example and very simplistic, just to get the point across. So can we move to the next slide, please? Thank you. So going to a more realistic example, we will try to find the sales break-even point right here. So the way you do it is you go to the income statement, and you can also go to the balance sheet and get information from different places, as we will see. The first thing you want to know is, what is our gross margin? So you can see the historical statements and come up with the margin. The formula is shown right here. Sales minus cost of goods sold divided by sales. So the gross profit divided by sales. So assuming we know what is the gross margin, then we want to know what are our fixed costs. So like we did in the previous example. So overhead costs are the costs that don't really change with units sold. So we will include rent, insurance, etc. But we will also have to include other expenses like principal payments, any owner draws, and other payments from the balance sheet. So, but that really depends on what we want to answer. So this is not like a recipe for everything. And I think the good thing with break-even analysis is that it's a concept more than it is a recipe for, like, it's very, very specific. So you can conduct break-even analysis on a profitability, on a specific profit unit in your company, on 2 divisions, or use it only for cash flow for, I don't know, for your Argentina division. So take cash flow only into consideration instead of income statement items. You may include balance sheet payments or not, so it's up to you. So what is important is to understand the concept behind it. So on step 4, we calculate the break-even point by dividing our fixed cost, so overhead expenses plus balance sheet payments in this example, with the gross margin, which gives us this number right here. And this is just an example. So limitations are, there are multiple of limitations, in my opinion, of this approach. So especially when it comes to predicting the future, because when you're asking how much time is it going to take for me to break even, you're asking how is the future going to look like. And we all know how difficult it is to predict the future in so many ways when you're dealing with companies and financials. So you may have different products with different degrees of profitability, and the whole thing becomes very complicated. Demand is uncertain. So let me just provide some examples as to how predicting the future in terms of breaking even is difficult. So as sales increase, the gross margin may not be stable because, for example, for economies of scale. So it's not like we know that this company has a fixed gross margin and that's that. The gross margin is can be very volatile. It depends on many other factors, many of which can be external and not controlled by the company. So another thing, like, for example, let's assume the company wants to change its inputs to some expensive to target a higher end, let's say, segments of the market and signal higher quality. That is going to change the cost of goods sold, of course, and it's going to change the sales as well. So it might change the gross margin. Maybe yes, maybe not, but it definitely will affect the gross margin. So, or another thing is that as the company scales, the fixed cost may also change. So your overhead costs or the balance sheet payments may increase. We say that these are fixed costs, and we mean that they are fixed within a specific period. But in reality, what we really mean is that they change like in steps. So as the company scales, these costs can increase, and that also needs to be taken into consideration. And if you take all of those things into consideration, you see how complicated it becomes sometimes to know what is your break even. And finally, you go to the other level of complexity of the revenue and expenses relationship. So, of course, revenues are directly related with expenses for so many reasons. So, for example, if you have a restaurant and one of the expenses is to use inventory, of course, to have raw materials. You have food to cook, etc. So if you have zero inventory, in an extreme case, you're not going to have any sales. So in that sense, your expenses are directly causing, bringing your revenue. Like as you increase inventory and your expenses, of course, you have more food to sell, and people are going to eat something and then pay the bill, etc. So, and that relationship changes, of course, as you change the input. So that's one thing we have to know. How do expenses change with revenue? And lastly, how do other factors affect this relationship over time? So you might have a new manager who is able to change everything in the company, and all of your predictions about a break-even analysis for the break-even analysis go to waste, because the new manager may be able to generate much higher margins because he may be able to, make the waiters smile more or be more responsive and generate and raise the quality of the product and sell the products at higher. Sell meals at a higher price with no additional cost, so have higher margins. So all of those things have to be taken into consideration. So that's the final point. And can we move to the next slide, please?
Sure.
Oh, by the way, before we go there, do you have any questions? Because that's a completely different subject, the sources and uses analysis.
So just, I'll back up one slide. Raise your hand if you have any questions before we move on. Jalal.
Yeah, sorry. It's not a question, it's just an additional comment. Thanks for the nice presentation, first of all. I think one thing that's interesting in the break-even analysis is the concept of the operating leverage. And that is basically the contribution margin, or the gross profit in other terms, over the net income. And what that says, this kind of ratio indicates by how much you will have an increase in profit if you increased your sales. So for example, if you reach a leverage of 5 times, a 1% increase in sales means a 5% increase in profit. So if you work around the formula, basically what it means is that the higher the fixed expenses a company has, the higher such a leverage it will have, basically. So that's a kind of embedded type of leverage that could be interesting to look at companies, because we always talk leverage in terms of debt, basically, but also this kind of operating leverage plays a very big role, meaning if you have company A and company B within the same industry and so forth, they have different operating leverages. If each of them makes a 1% increase in sales, that doesn't mean a 1% increase, or that doesn't mean it's proportional to the increase in profits. So we need to look also into this kind of structure.
That's a great point. I totally agree. Operational leverage is very important. And just a final comment, because like I think I might have concluded with the statement that this is very complex. Yes, surely, like everything can be very, very complex if you go in detail and scrutinize it, but it doesn't have to. And we can answer the questions that we want to know by making assumptions and making our whole analysis more simplified. Just wanted to complement the presentation with that point, so that we don't get crazy about how complex this is, because it's not. So the sources and uses analysis. Okay, that's something completely different.
Oh, we've got one hand up, Athenagoras, for Eric before we move on.
Oh, sure.
Oh, hey, great presentation. It's just want to reiterate that break even is it's tough. It's a very complex analysis that one works on, because I know that the financial modeling that's used for some of the break even analysis, the ones that I've seen or worked on in the past, we look over time to see, looking at all the variables, and they're always constantly changing, and it's hard to forecast. And sometimes we're looking at forecast that goes out 5 years, but then when is our break even? So we give ourselves a certain break even of like a year or 18 months that we're looking to break even. But again, it's all based on all the assumptions, all the variables that we have in play. And as you mentioned, it's always changing, and how do we always adjust to those changes in as far as leadership and what they want to see in the modeling. So it does become very complex, as we have certain people who just work on the financial modeling for break even. It's a good analysis, but it's very complex. I think it's just depending on what the sources or the variables you have at hand and what you can work with. So there's a lot of assumptions.
That's a great point, Eric. And yeah, it's very complex if you want to be very accurate, and you can create those models, etc. But if you want to simply, like make some rough estimates and have a qualitative, or not qualitative, but like a very quick judgment, I think you can also do that and make assumptions, as you said. So yeah, depending on the time you want to allocate. Like if you're looking for an investment and you're looking at many investments in many different companies, you can come up with we don't always have to go to such low depths and waste our time. If we want to just make a very quick qualitative judgment about something. So yeah, I think it depends what we want, what we're looking for. Thanks a lot. So the sources and uses analysis. Oh, I see you. Let me see. Oh yeah. Thank you.
Fat fingers. Sorry.
Yeah, great. So this concept is a quite simple concept, and it relates to, I would say, the presentation of the cash flow statement. Like it's a step before the cash flow statement, in my opinion, and it's the initial step basically for the preparation of the cash flow statement, because it tests the accuracy of the balance sheet, and also distinguishes the source of funds from the uses of funds, so cash. So of course, before the cash flow statement can be prepared, we need additional information. So this information can comes from the income statement as well as the balance sheet and other notes that are found in the accounts. But you can get very very informative insights by looking at the sources and uses of cash next to the balance sheet. So I think the PDF that we had with Panera Bread had a table which will be shown in the later slide that shows the next to the balance sheet, the two columns with the uses and sources of cash. And that is important because we often ask, where does cash come from? What does it come in from? So the sources, and what does it go to? So the use of cash. And we're really talking in balance sheet terms about the fluctuations of the cash and cash equivalents account. So if we just to show you that this holds true in mathematic terms, in accounting terms actually, we have here the basic equation. So assets equals liabilities plus equity. Then assets can be split into current assets and fixed assets. Then current liabilities, long-term debt plus equity. So we do some manipulation, and then in the semi-last row, we have cash plus accounts receivable plus inventory minus current assets, etc. This is just a simplification. And if we move everything to the right and leave to the right-hand side and leave cash on the left-hand side, the equation, this is cash and cash equivalents, or it's supposed to be. And what we can see is what happens to that account once we change the long-term debt, the current liabilities, the equity, accounts receivable, etc. So what will happen to cash will what will happen to cash will determine whether it's a source or use of cash. So as for example, long-term debt increases, that is so liabilities, as they increase, that is a source of cash, because we are generating, we're able to get cash. It's a source of cash to the cash and cash equivalents account. Same for equity when you raise equity. And for assets, of course, if you see an increase in inventory, you probably use cash to do that. Fixed assets, same reasoning, etc. So let's move to actually, let me just say a comment, because for the accounts receivable, it might not be straightforward. So, use of cash is pretty easy, like for assets, for most assets, you just need, you used some cash. But for accounts receivable, or let me actually it's for accounts payable, because that's even more complicated. You will understand the accounts receivable. So the accounts payable basically tells you that it's a reason, like the word source is like, it tells you that it's like a reason you still have the cash. So if you buy something on credit, then the credit is the reason you still have the cash in your pocket, rather than being required to give it immediately when you bought whatever it is you bought. So basically, accounts payable is a source of cash, but it's basically the reason you still have the cash, because you have to pay it later. But another way to look at it is because someone lends you that money and you have to pay them back. And that's the more straightforward way, perhaps. But let's go to the next slide. Yep, thank you. So this is the Panera Bread Company example that we were given. And as it's always useful to do, it's good to look at the main changes that happen, as Michael said, either whether that's percentage-wise or absolute value-wise. So here we see a 47 million or 48 million actually property and equipment net increase. So that was a use of cash. and 18 million in intangible assets. And can we move to the next slide? Thank you. And again, with red, we basically spot the big changes and in uses and sources, and we try to make sense of what those numbers mean, where they come from. And it's always, I think, good to make a story. What is the strategy like behind the company? Like, why are they doing this? Like, those numbers, okay, they are big and they are meaningful, but what are the underlying economics and the reasons behind those financial statements? And that, I think, should always be the case when we're analyzing financial statements. And as you can see here, the sources and uses of cash, they don't balance in the end. And that is because you either are going to have a net use or a net source at the end of the year. So either cash and cash equivalents will be increasing or decreasing. So basically you want the change in all the other items apart from the cash and cash equivalents to equal the change in cash and cash equivalents. And that is indeed the case if we look at the balance on the right. And we know that, during the year, Panera Bread had a net use of 6.6 million, which is also reflected in the 6.6 million increase in cash and cash equivalents. So that concludes this presentation, and thank you very much.
Okay, any questions? So I'm going to ask you a question, Athena Gorst, because this is probably the biggest thing that people get wrong in this class, is they put sources and uses, they put the number in the wrong column. Can you give the people on the web conference guidelines on how you know which column to put it in? Because you get it wrong when you put a source into a use column.
Mm-hmm.
It happens a lot. And the number's right, but it's in the wrong column. The answer's wrong.
Mm-hmm. Yeah. I think the best thing to do would be to go to the first slide of the uses and sources and uses of analysis, and just to the next one. And just talk a little bit more about that. So, okay, yeah, it's a mathematic formula, but that's one way to do it. We have to understand the concept, like what is the concept behind it intuitively, as you, I think, are suggesting. So the use of cash is easy conceptually. It means that, so if assets are increasing, then it was a use of cash because you need cash to increase your assets. Like if you want to buy, I don't know, as we're in the previous example of the restaurant, if you want to buy raw materials or if you want to buy tables or whatever, or make capital expenditures, then that is a use of cash and it increases your assets. So you basically, like for someone that computes the sources and uses, they simply have to look at the balance sheet, and within a year, between 2 year periods, you see the change. And if you really want to be accurate, you simply look at this table and in sources and uses, the table on the right, which tells you exactly what happens. I think the only account that is difficult to understand conceptually is the actual cash account. So the cash and cash equivalents account, because if it increases, that is not a source, it's a use. So if it decreases, it's a source. So that doesn't make really sense conceptually. I think that's the only one that doesn't really make sense. And the way to look at it is, like, one way to look at it is that it's the residual, yes. But one way to look at it is like, this is a standalone account. So so basically, if you put money in there, it's like you use money to put money in that account. So the account increases. So that's one way to look at it. But I wouldn't say that it's easy to understand conceptually. It's more easy to understand what happens with assets and liabilities, in my opinion. So yeah, in order to have liability, like if liabilities have increased or equity has increased, that means that you have more debt obligations, but also you generated capital. So if you generated capital, that is a source of funds. So I would say those are ways to understand the concept.
Okay, thank you. Raise your hand if you have any questions on sources and uses. Okay, looks like you got away pretty easy, Eugors, because that one can really be a twister for people. Thank you for your presentation.
Thank you.
Okay, now on to vertical analysis with Gordon. Gordon, are you ready?
Yeah, I'm ready. Do you hear me well?
Yes, welcome.
All right, great. All right, if you go to the next slide. To begin, let's look at a financial statement. What is shown to the left is an income statement. You can see different lines listed under revenue, different types of expenses, and net income. Furthermore, you can see how the values change across 3 different fiscal years. A cursory glance at the statement gives you your cash flows for these different line items, but it still leaves so many questions that cannot be answered immediately from these metrics. For example, if you go, if you click the next, should go to the animation. Okay, now how much are bakery cafe sales contributing in terms of overall total revenue? If you can hit next again. Is labor contributing more in proportion of expenses in fiscal year 2011 versus 2010? If you hit next again, one more. And are there any interesting trends between years in terms of how they're moving against each other? So, you know, how can we answer these questions? And if you hit next again, vertical analysis can help. So if we go to the next slide, to start off, you know, what is vertical analysis? I guess the textbook definition, it's a proportional measure analysis of a financial statement. So what does that really mean? It's basically a way of representing data relative to each other in terms of ratios or percentages. This will become clearer in the next slide when we go through live examples. But to start off, in terms of income statements, they are typically represented as a percentage. Each line item is representing a percentage of gross sales. And for balance sheet statements, items are typically stated as percentage of total assets. If we go to the next slide.
Yeah.
I mean, yeah, next animation. So what does it do for us? You know, it provides analysts or organizations with a powerful way and a powerful accounting visualization, basically using accounting data to help answer questions. It illustrates relative proportions of different line items for a single time period. And also, it's also, because you see these different time periods, you can monitor changes in proportions over these different time periods. And, you know, why does it matter? So if you go to the next animation, it matters because, most importantly, it answers questions and raises alarms. How can I easily compare similar companies of different sizes? So, for example, in our case study, we have Panera Bread. You know, another similar company might be Corner Bakery. They may or may not be different sizes. How can you compare the two? And you could see who spends more on what or who spends less on what. You could also see maybe year over year, why is there a spike in proportion for labor expenses for one fiscal year over another? So going to the next slide, let's just go through a live example to kind of see the math behind vertical analysis. So at the very top, you see sales. Sales is 100%, so everything's going to be listed in terms of sales. If you hit the next thing, it should go through the calculation. So cost of goods, so you see this is represented in millions, so 1344 over 2311, which is sales, times 100 gives you 58.2%. And if you hit the, if you kind of click through, you could see all the different sort of metrics measured in terms of sales. So you see for depreciation, you see it in terms of 276 over 2311. So that comes out to 11.9%. Just kind of, you could kind of go through each one all the way up to net income. You could kind of just see where the math is coming from. All it is just a simple percentage for each line item against sales. Yep. So now let's look at a little bit more complex example. What we saw earlier was just a pretty simple sheet. Now let's look at the Panera Bread company's income statement that was in our slide, and we can see what sort of insights we can derive. Taking a look at year-over-year revenue, we can see that there's a small trend where bakery cafe sales are starting to contribute more terms. Actually, taking a step back, to the left you see the cash flows, and to the right you see the vertical analysis. So fiscal year 2011 to the left, that's the cash flows. Fiscal year 2011 to the right is where the vertical analysis is done. So looking at bakery cafe sales, we see that it's increasing in terms of cash flow over year, but you can also see how that is contributing in terms of total revenue year over year as well. And you could see that what could this mean? It kind of gives you an alarm, like, hey, maybe I should look into this. Maybe there is something going on economically where there is an indicator that there is a higher demand for bakery cafe items versus or the franchises are not growing as much. So it kind of just gives you an area to kind of zoom into. It doesn't. I don't think it necessarily explains what's going on, but it kind of gives you a tip or an alarm where to look. Another interesting thing to look at is, say, labor and costs of food and paper products are about half of total revenue. So you see that to the left, it's for fiscal year 2011, it's 0.258 and 0.26. So these are in terms of ratios, not percentages. But why could we see that cost of labor is going down proportionally versus cost of food and paper products are kind of contributing more? There's, again, you could kind of think about what has Panera Bread been doing. When I walk into a Panera Bread now, I see that a lot of Panera Breads have point of sale kiosks where you can enter in, and maybe the cost of commodities, maybe paper, maybe items that go into the food, maybe those commodities have been rising as in relation to each other. So that's something you kind of think about and try to kind of zoom into as well using vertical analysis. And also another thing, what's interesting to note is that for gross margin, you see it increasing year over year. It looks like it's been growing, but then when you look at it in proportion to revenue, you can see that actually, in fiscal year 2010 is actually greater than it was in fiscal year 2011. So it just gives you kind of areas to look at, because sometimes just looking at the cash flow itself is a hard way, unless you can kind of do the math in your head. It's not always the easy way to look at data. So from these examples, you can conclude that vertical analysis is a pretty helpful tool to interpret data in a slightly different way than just purely using cash flows. So that's it for me for vertical analysis.
Thank you, Gordon. Feel free to raise your hand if you have any questions on vertical analysis. And when you do analyze this one, again, an easy thing to take a peek at is, because you're going to be asked to make a commentary on vertical analysis. Make sure that you comment on the big numbers. So anything that is a large percentage, anything that looks big, that's a standout, you need to comment on it. Where something has a large change. So basically anything that sticks out like a sore thumb, make sure that you acknowledge it as opposed to just ignore it. Okay, Gordon, thank you for your presentation.
All right, great, thank you.
And now we're on to reading an income statement. Ezgi, are you ready?
Yes, I'm ready. I'm here. Hi, everyone.
Hi, welcome.
Thank you. So actually, we saw the income statement in Gordon's presentation, and can we go to other slide? So income statement is, at the beginning, I have to say I'm a nonprofit professional. So actually, nonprofit organizations, have this basically same statement, but it's not income statement of activities. So, but it's the same thing. So income statement is one of three financial statements. The other two are balance sheet and cash flow statement. And it's actually if we define balance sheet as a snapshot, income statement is like a movie. Like it shows the organization's performance over a specific period of time. It can be monthly, quarterly, semi-annually, or annually. And it's looking at income statement and understanding it and knowing to read it is important because it shows the profitability and growth potential of the company. So like for investors, for example, it's important, like they want to see the company's income statement to understand, especially like over the years, to understand the performance of the company. Actually, income statements, like the ratios, like that we've seen so far, are more useful to compare like different companies or compare the company against sector averages or something. But income statements, like since the sizes of the companies are different, income statements gives actually the a particular organization's company's performance rather than the comparing it with other companies. And basically it shows revenues, expenses, and net profit from both operational and non-operational activities. So can we go to other slide? Thank you. It's the example from our PDF, Panera Bread Company's income statement, and it has 3 fiscal years numbers. So if we go to buy one buy,
do you want the red circles, you mean?
Yes. So it shows basically total revenue and total cost of goods sold, and then gross margin. Gross margin is total revenues minus total cost of goods sold. It's important to have gross margin, to see gross margin in the income statements, because it gives you the information of like what is the direct cost that are directly related to our sales, and if it's profitable, like at the first step, rather than overhead expenses. Before overhead expenses, is it profitable to produce this product, like just if we look at the only direct costs. So after that, like after gross margin, we have total operating expense and operating income, and then we have other expenses, and finally the net income, like all total revenues minus all expenses, we have net income. It's important to say that it's not income statements doesn't show the cash. If we look at this revenue, we may not have the this revenue as cash in our, for example, bank accounts, or it may be these expenses may be like payables, for example. If we can, if may not spend cash, but these are the revenues that we earn in this fiscal year and the expenses that we spend actually. So and if we look at the numbers, we can looking at net income is important because it gives you the information if this company is profitable, so if it's actually sustainable, because even if like total revenues increase, if your expenses increase more than your revenues, then your net income decreases actually. So it's good to look at the first net income, then revenues, and we see that net income of the Panera Bread company is increasing in these 3 years, and total revenues also. And again, if we after revenues, if we look at the gross margin, again we see the gross margin also is increasing, which means Panera Bread company is good at increasing revenues, but also, of course, its expenses will increase because the sales are increasing. But to find a way to increase expenses less than the increase in revenues, so that they have increase in gross margin also. So, and as I said, again, after gross margin, you have operating income, and finally net income. So it's basically this. Thank you. if you have any questions.
Okay, please raise your hand if you have any questions for Ezgi, and thank you for your presentation.
Thank you.
Any questions, comments? Beautiful. Okay, everyone. That concludes our financial ratios for today. We actually finished almost exactly on time, about 3 hours into it. And now what we're going to move on to, so thank you all for your participation. Now what we're going to move on to is assignments for Web 1. There are some questions about that. We've got, let me do a